Ladies and gentlemen, good morning. My name is Widat Talib. Just to clarify, formerly a CNN Business Arabic senior reporter, currently unaffiliated in my transitionary period. I would like to welcome you all to the second day of the third edition of the Saudi Capital Market Forum. Welcome. Last year, I stood on this forum's very stage, and at the time saw over 2,600 attendees, more than 2,400 meetings, over 330 investors represented by 130 international investment firms. This is a true reflection on the greatness of Saudi Arabia today and on the greatness of Saudi Arabia in the future. I am pleased to be standing here before you once again to navigate you through the entire day and to witness history being made together once more, inshallah. Now, without further ado, allow me to introduce the first session for today, a fireside chat featuring Mr. Khalid Al-Hussan, the CEO of Tadawul Group, and the moderator of this session, Mr. Per Elnar Elefson, the CEO of Amundsen Investment Management. Gentlemen, please make your way to the stage, and thank you.
Khalid, thank you very much for joining us today. And thank you for inviting us. I heard from your staff that there's 3,000 people here at the conference, of which 600 coming from abroad, so I think that's already a great success. But as an investor, the last 3 years have been quite intense. Say 2021, you had some post-COVID euphoria. 22, you had a new war in Ukraine and new supply chain troubles. And then return of inflation, higher rates. Kingdom has sailed through this. The capital markets are working fine. But what do you think are the major drivers of capital markets over time here?
Thank you, Per. Assalamu alaikum. Good morning, everyone. And first of all, let me take the opportunity to thank everyone for their participation and joining us for the Saudi Capital Market Forum. And I hope you had a very successful and fruitful first day, and wish you all the best for today. So as far as capital markets last year, in my opinion, I think markets or 2023 has been a volatile for capital markets globally, and that's as they contended economical uncertainties as well as geopolitical instability, inflation, interest rates. All of these have made capital market a little bit volatile for last year. It is with no wonder that the key trends, in my opinion, for capital markets are three that I can think about. The first one I would like to highlight is diversification. And when I talk about diversification and the importance of diversification, it's not only at the individual portfolio level, it's also at the entire market level. If we see exchanges specific focusing on offering single securities in their exchanges, they have been very volatile in their activity. Being focused also in single securities expose these markets to risks, while diversification always drive resilience of the market. And if I look at it in numbers, look at IPOs. Last year, there have been a drop in IPOs, volumes by 8%, with proceeds down by 33%. And that tells you the core security offering by exchanges is always equity, or has been equity. And equity is very volatile reflection of geopolitical, economical, inflation, interest rates. They're the first to be impacted if you're offering that. So diversification is number one. The second I want to highlight here is data monetization. Market infrastructure companies always sit in a wealth of data. And exchanges or market infrastructure companies who invest on data monetization have been doing so well. It is a great opportunity for diversification of the business as well as growth of their business lines. And it's proven in the record of more advanced developed market who have started earlier in the last few years of investing on the data monetization in their business. Look at their revenue mix today. We have seen markets that data represent 30, 40, sometimes 50 or above % of their revenue mix. The third key trends I want to highlight here is connectivity. Stock exchanges in particular these days do not work in isolation. They're integrated. Investors have access to many platforms around the world as well as issuers. So exchanges or market infrastructure companies who invest on connectivity, allowing access, having the right infrastructure, are always in a more better and advanced stage compared to other markets. So these are the three key trends that I see for capital markets around the world. And for us at Saudi Tadawul Group, these are one of our priorities that we're investing in our growth strategy for the next 3 to 5 years.
You touched on IPOs, and in global markets, one of the trends we've seen in the last 2 years, 22 and 23, has been actually having more take privates of companies going from public to private than IPOs. Obviously, this ebbs and flows, but in the kingdom, you managed to attract more listings. But how are you working to ensure that more companies actually choose to go public rather than staying private for longer as they could through kind of private equity capital?
Well, we always watch what is the requirements of the private companies. Is it easing the access to our market? And this is one of the things that we have done in the last few years, where we introduced the parallel market NMO. It's a second equity market with lower requirements to enable small, medium enterprises, family houses, new ventures to join a market with lower requirements to access funding requirements, exit for some their investment and diversifying their portfolio. So this is one of the things that we do. We have a great team looking at listings where they visit and educate Saudi corporates about the benefits as well as the challenges to make them ready for it. The reforms that are happening in the kingdom under Vision 2030 is also another vehicle for attracting companies to the market. because these companies see opportunities of these reforms. They require funding, and the market is an additional platform compared to the traditional funding that is happening from the banks. They open new channels for them for extra funding, whether this is through equity market or through the debt market as well.
Now, I've talked a lot about the ambitions for the equity market, but how important is it for you to diversify the group as you're bringing the exchange and the group into the next decade?
Well, diversification is very important, as I mentioned. And if I look at it since the launch of Vision 2030, followed by the establishment of the Financial Sector Development Program, we came a long way building a sophisticated market, and we continue to have the ambition to do that. And of course, diversification, in my opinion, sit in the heart of such ambition. So what we have done is we launched our new strategy plan, or growth plan, if I may call them, that is focused on 7 key pillars. Of course, equity and capital formation sits at the beginning of that as a capital market infrastructure, but it's not limited to that. We are looking at debt, commodities, derivatives, security services, data and analytics, and IPs. And that all of these are why we're doing them is basically to build an advanced capital market. And as mentioned by His Excellency Minister of Investment yesterday, to contribute in developing a global financial hub in Saudi Arabia. And this is very essential for us. We have advantage. We have advantage of Vision 2030, the reforms happening. For us as a capital market, we do think that we have even an additional advantage, which is the time zone. So we could capitalize in creating the bridge between East and West. We are the largest economy in the region, the most liquid exchange in the region. So that will help activate us as a financial hub in the region. And if I would give an example of that diversification, I think the debt market has started to flourish. Total issuances exceeding 550 billion Saudi riyals, and we're still in the beginning. I think that was covered by both His Excellency Minister of Finance as well as His Excellency the Chairman of CMA. That's key focus for the development and diversification of the market. We launched our 3rd derivatives contracts, single stock options, so also that to serve the diversification purpose and widening our offering to our clients. And I would mention lastly our recent acquisition of a strategic stake on Dubai Mercantile Exchange that also mark our entry to the commodity market space. So all of these just highlight the importance of our diversification for us as Saudi Tadawul Group and for the Saudi capital market as well.
You mentioned the acquisition of Dubai Mercantile Exchange. Can you touch a bit more on the strategic thinking around that? As a former commodity trader, I'm quite interested in understanding how the region as a commodity hub can actually also become a leading commodity exchange.
Absolutely. So in addition to what I have said in building an advanced capital market, the diversification of our offering to serve even additional clients, I would highlight the rationale and the focus for us on when we made that decision of entering that space. I'll highlight 3 things. One, of course, the most important is to enable the reforms of the country and the economy. As you know, there are a lot of developments across sectors within the economy that needs to be served by a commodity market, whether these are for the minerals and other type of initiatives within the economy that would require, a pricing reference driven by a market. Today, most of these are using international markets for picking up that difference. We do think that we get the opportunity to enable that to happen within the kingdom. Second, for the diversification purposes, we want to strengthen our position, strengthen our offering for our clients. And third, of course, as a listed entity, we want to grow our business by offering further products and grow our business lines. And this is one of the business lines we're focusing on.
If we turn to data monetization, as you mentioned, and most exchanges worldwide have actually moved into the data sphere, either to index providers, ESG data, even sort of data providers as a Refinitiv moving into LSE. What do you see as the biggest opportunities there? Is it simply about leveraging the data you have already available, or you're also looking at acquisitions to grow your footprint?
Sure. So looking at data outside the perspective of capital market, data today, I think I can fairly say data moved from being a good to have in the daily business that we do to a necessity. Everybody look at data from the perspective of decision making, designing products and services, client behavior, competition behavior, etc. So data is becoming an important element of any business that we do. If I look at it from the perspective of the capital market and us at STG, I would focus this also in three things. One, of course, leveraging the wealth of data that we generate. And I won't exaggerate when I say we create millions of records every day from our activity. Pre-trade, market trading activity, and post-trade. These huge and wealth of data that is created and built up every day. So utilizing that to offer more products, more services for our clients. That, of course, one of the focuses. The second is basically, in the focus for STG, is to build the infrastructure and capabilities around data, because it is a very important element for growing the business of STG going forward. Third is, as you rightly mentioned, is acquiring capabilities. And that is in the space of acquiring data or sourcing data, as well as acquiring companies on the space of technology and data that enables us to expand our offering. And I'll use an example. We started actually on acquiring such capability. Last year, we have acquired controlling stake in DirectFN, which I can claim it's one of the local technology capabilities that we have started to acquire. And the good thing, they are also the largest data provider in the kingdom. So it has the mix of technology as well as data. But we continue to build that capabilities within the group.
I have to ask, is there any considerations on AI in these acquisitions? Or?
Well, AI is, I think we're all watching AI, of course. We're looking at all of these type of technologies that we could utilize to provide services, as well as analyze our product designs and client offering.
Now, if we turn to the international investors, where quite a lot of us come here, I think the Saudi Capital Market Forum is the one place you have to be if you're an international investor in the kingdom. And I've also noticed that you're making efforts to get international investors that maybe haven't invested so much in the kingdom historically to come here. And I mean, the reforms that we've been through sort of to the market in order to open it up, the market was historically quite close to foreigners, have been really substantial. I was on the receiving side of that in 2017. But how are you capitalizing on this now? And what are you sort of seeing as new opportunities to connect the exchange of the kingdom to the rest of the world?
So, I wouldn't say, I would like to say that since we opened up the market and thinking about how could we attract foreign capitals, foreign inflows to participate in our market, whether these active or passive, money coming to our market. We worked very hard to adjust, change regulations, change operating model, promote the market, promote the changes, listen to international investors. And to the date you have mentioned, 2017, we're looking at that date. At that time, we only had 50 registered QFIs in the system. And today, we are more than 3,700 QFI registered in the system, owning roughly around 85 billion US dollars of positions in the Saudi exchange, or in the Saudi corporates, actually. So, and there is also another advantage of promoting the kingdom overall. I think the government has made over 700 regulatory and business reforms over the course of the last few years. And all of these are focused on opening up the economy, opening up the market, and promote investments to the kingdom. So we continue to do the same. We continue to do this in two legs. One, continue to do and diversify our offering to the market or to the investors. Second, we continue our promotion and education process, education efforts. So we're all over the places. The team are in the East and West, speaking to investors, listening to them. The exchange is doing a tremendous effort on conducting roadshows with Saudi corporates to talk to investors. And today is one of the I would say, it's a local roadshow where we have lots of corporates today meeting with investors over the course of yesterday and today. It's all about continuing to progress and promoting market and listen to the changes that is required to standardize or integrate our operating models with the, what I would say, a familiar process for international investors.
What do you see as the role of the foreign investors? Because in a certain way, right now, at least the kingdom has ample capital to deploy in projects.
Of course.
The question is, what do the international investors then bring to the table?
So they will bring multiple things. Of course, capital is the most important. And I think as we're looking at the IPOs earlier, there's a supply and demand. So we're always, as a capital market infrastructure or as an exchange, we need to create, if we're doing so well in the IPOs, we need to open additional channels for the demand side. So that is very important to fund corporate growth, Vision 2030 initiatives that are accessing the market as a vehicle of funding. The second thing I would like to highlight in here, the importance for investors, is the standards. We always want to make sure that what we apply as far as market conduct, design of our products, disclosure requirements, ESG, investor relation, are always within the international standards and common expectations. So that also another element of maturing the market in several elements of the operations of the market, in my opinion.
I think those are important points. Now, in the Saudi Capital Markets Forum, you're bringing together in Riyadh investors from around the world. How does this platform align with your broader ambitions, and what should we expect to see next?
So this is the third version or the third year of the Saudi Capital Market Forum. I think this forum is uniquely positioned. It's focused on capital market topics. It's very unique. And I would say, just to highlight some statistics for the forum, to highlight the importance of the forum and the success, in my opinion, we had more than 4,300 individuals attending the forum yesterday. We had requests for more than 15,000 meetings. We could not host 15,000 meetings. We had 75 outlets ready for our clients and investors to meet. But happy to say we have booked more than 4,200 meetings to be conducted between yesterday and today. These are significant, in my opinion, numbers. We have more than 650 investors registered and attending the meeting, the conference. So for us, this is an important dialogue for the capital market overall to discuss certain important topics, opportunities, but also a dialogue for investors, Saudi corporates, market intermediaries, to talk about challenges, opportunities, partnerships. And we would continue to elevate the Saudi Capital Market Forum because of the success and the demand required by our clients. So we'll continue to invest on this forum. And actually, I'm very delighted to announce today, and for the first time, we will be taking the Capital Market Forum beyond Saudi borders in collaboration with the Hong Kong Exchange. In May 9th, we will be conducting the Capital Market Forum in Hong Kong under what we call CMF Connect. And we hope that also elevate the integration of the Saudi Capital Market Forum with the rest of the world. This is the first step for us to take it outside Saudi, and we hope that will be also an additional value to the forum in the future.
Exciting. Thank you very much, Khalid.
Thank you very much, Pierre. Shukran jazeelan. Okay.
Thank you, gentlemen, for this very insightful talk. Esteemed guests and fellow enthusiasts of the economic world, allow me to introduce this grand segment of SCMF, one of intellectual prowess and visionary insights, the economic sprints. What caught my eye about this segment was its name, Sprint, which means running very quickly, and which also means that this segment is going to be somewhat of an exercise to us all, but don't worry, no one's going to be doing any actual running. It will be more of a cognitively stimulating exercise to feed our brains with information from 5 industry leaders in a quick, fast pace in regards to global economics. Today, we are honored to have 5 distinguished speakers from the top echelons of the economic industry ready to ignite our minds and fuel our discussions. In the first economic sprint, we have Mr. Mazen Al-Sudairi from Al-Rajhi Capital. Following him, we will be listening to Mr. Rajiv Sibal from Morgan Stanley. The sprint then continues with Mr. Walid Mohsen from Goldman Sachs, followed by Mr. Luis Oganis from JP Morgan, and finally, Mr. Ahmad Shamsuddin from EFG Hermes. Each industry pioneer from those whom I just mentioned will take 15 minutes to tackle global economic topics, both to feed our minds and to share their intellectual insights from their professional standpoints. The year 2023 held promises and challenges in the global economy with shifting dynamics and emerging trends. And as we look ahead to 2024, the forecast is ripe with opportunities and uncertainties, beckoning us to navigate through the complexities with wisdom and foresight. So let us embrace these economic sprints with open minds, ready to absorb the wisdom of our esteemed speakers and gain invaluable insights that will shape our understanding of the economic world. And as we embark on this intellectual voyage, let us not only delve into the current economic landscape, but also gaze into the promising future, hopefully. Thank you, and let the sprint begin. Please help me welcome from Al-Rajhi Capital, Mr. Mazen Al-Sudairi.
you, Tadawul, for organizing this event. Maybe we're going to talk who we're going to trust today, the fixed income or the equity market. Maybe you saw the latest actually numbers from the Bureau of Labor and State last week, and inflation. We saw that the inflation is not actually falling down relative to what has been expected. It came at 3.9%, the core inflation. The 10 years bond had went up to 4.3%. That shows the market is a little bit pessimist in fixed income. But in equity, we saw year to date in Russell 2000 growth, that means the most sensitive to the interest rate, and it is still lagging to NASDAQ. It had rallied about 3%, moved about 3.5% and reversed all of the losses. So who shall we trust, the equity market or the fixed income? I've been raised to respect age people and fixed income, but now I'm starting to believe more equity market. The reason is we've been seeing inverted curve since 22. Until now, we didn't see recession. We're actually seeing a soft landing, conferred with the strong actually retail sales, conformed either with the strong GDP happening in United States. Market is actually believing in some soft landing gonna happen. But does the inflation gonna fall down? Is the cut gonna happen? And this year, this is the major question. And the major factor is across financial market in year 22, you saw the correlation, positive correlation between bond and equity in year 22. Both they fell together because of expecting higher interest rate that's going to continue for long. If you remember in September and October, it was the biggest actually fall of equity and bond market together. So back again, now let's see the image. With inflation that it is, if we exclude sheltering, why the market believe the cut going to happen? I think because if we exclude sheltering of inflation, we're going to find it reaching 2%. It's still sticky, but it's in about 2%. It has been 3 months, did not fall below 2%. Sheltering, the way they calculate it and the core CPI is a bit lagging 6 months, 6 to 9 months. So if we check to the actual and current indexes, as Zillow index, we'll find it actually falling down. So there is a lagging effect. Confirmed either with the PPI, which measuring the input of productivity, that it's still falling down, and the CPI index. On the other side, employment is sticky at 3.7%. It's had reached 3.9 and fell back again, 3.7. Labor force still strong, retail is still strong, and the Fed members, them age on average between 50 to 70 years. They never experienced something like that in them career. So they have to be cautious. Them keeping the interest up at 5.2%, 5.3% average. They will keep it for a time to be sure that the inflation will fall, and then they will start to do the cut. So if it didn't happen, they maintain it at 5.3. And the other side, if it is full, they will start to do the cut. For that, we're more to believe that the Fed is cautious, but the numbers are supporting to the cut, but market was predicting it to happen in March. You see right now, all of the probability has fallen down. The majority is moved to between June and September. Where Raj has actually predicted that in December, we had actually issued a report and mentioning that we think it's too early to see it in March. It's more probable in June. Number of cuts, we can go 3, might exceed the 3 cuts, but won't happen before June. It's too early to see it before June. So I think this is the most probability, and why that market, equity market, is taking pricing in this changement and maintaining the performance about the equity market. When we talk about market, I think in Saudi Arabia, mainly you have 3 factors. Actually, the point I want to reach it here is it's the active investor. It is the 5th point I'll talk about it today. It's the active investor versus passive, plus what are the factors affecting the market. So I start with the interest rate. Now we're moving to the 2nd factor, which is China. And I'm seeing so many pessimism actually report against China and over actually optimist against China. I don't think we should ask China to recover now. I think China is actually stopping. I'm looking to the to the half full glass. I'm not looking to the empty part. I'm looking to the full. But China is avoiding a crisis. The real estate industry there is struggling, and China is trying to maintain it. There is 2 indicators I look to in China that non-official, but more correlated to the market to a certain level. The yuan to dollar exchange plus the MCI, MCHI index. It's ATF related to China market. It's still till now cheap. The forward it's traded at forward about 10, between 9 to 10. It had depreciated more than 4% year to date. That shows that the market is not expecting growth happening in the short term. But despite we're seeing GDP growth on a range 5%, but the market is not predicting that in the coming actually period. But if we look to dollar yuan, despite there is a control and there is a pitch actually, but still they have the pivotal range to move in, still to the level beyond the financial crisis, 2008, 2009. So it's about 7.2. Dollar is equal to 7.2 yuan, which still there is no oversell happening in China. Things are, we think it's, into the coming period, are trying to stabilize the economy. So I think we have to give China time. About the consumption of oil, we're seeing either according to Aramco numbers, the consumption of oil is still healthy, and that's taken us to the third pillar, which is oil market. About oil, we saw so many pessimism actually estimation that oil might fall, and we saw oil on a range 76, 77, and there is some explanation saying that geopolitical reasons had actually, because of the Red Sea, had maintained oil market. That might happen, but to a certain level. But if we look to the demand in the market, for example, if we look to the NYMEX spread of refineries, we will find it at a level, if we exclude Russia, Ukraine crisis in 22, it is the highest level since 2019. And that shows the demand of the derivatives of oil. It's the highest spread I ever seen of a barrel of oil. So this shows there's a healthy level of consumption. The inventories are falling down. Since the agreement of OPEC had filled, the OECD inventories had filled by 70 million. That shows the market is balancing. And if we take either the lowest predicting of oil consumption this year, which is 1.3 million from the AIA, that will give us a strong, it will give us, might reach a balance in the coming 2-3 months. And that's confirm our view that the range of oil will go between 75 to 85. And according to our calculations, Saudi budget was being based in 23 and 24 based on $80 per barrel with a production of about 9.2 million barrels. So it is very healthy actually level of prices for Saudi Arabia. But back again, when we were doing the analysis for the oil market, we tries to ask some points that might create the issue with supply. According to our calculation, the shale oil needs $52 to maintain extraction, to maintain financial, all of the cash out, including financial expense, taxing, including capex. All of that will need $52. Last year, the oil prices was about $80, so it was at a healthy level of oil price. Despite that, we didn't see strong actually growth in quantity from shale oil. The biggest field of oil in United States, which is Permian, did not grow more than 300,000 barrels. Usually the average, it goes up by 500,000. The other fields are back again to the level of a pre-COVID, 2018. The total is about between 600 to 700. But if with this healthy level of oil, Permian did not exceed 300,000. Is that the peak of oil level? I'm not sure. And this might create a global actually crisis. I remember Occidental, CEO of Occidental, it's a shale oil company, was talking about shock of supply, and market was not listening to him. Now, year 24 will be a good example, a good actually measurement for the supply of shale oil. Could it exceed this? Could it exceed 700,000-800,000 barrels? We don't know. We're going to see it in 24. But if it didn't, this might create an issue regarding the global supply. But back again, with this level of inventory, with this level of inventory in OECD countries, 2.7 billion barrels, to the global consumption of 103, taking market to balance without a shock of supply. Back again to the Saudi market. So we're talking about oil and cut of interest rate and China. About Saudi market, if we look to the Saudi market, reverse to the MSCI, I'll talk about it from active and passive perspective. If we look to the Saudi market from the MSCI emergent market, in the last 10 years, it hardly performed 4%. In 5 years, performed negative 4%. Saudi market in 10 years had performed 35%, in 5 years more, 47. Why is that happening? That the Saudi market had exceeded the emerging market in year 21. Year 21 was a major year for Saudi market. Number of companies has increased. The valuation of market has started to increase. Why did that happen? We think there's 3 reasons. The inclusion with MSCI and FTSE and entering a number of Q5 institutional investor had added more efficiency to the market. And we observe the rallies always start with the Q5 investors. And then the net buying, according to Tadawul numbers, are turning positive with the Q5s. Second thing, what we observe it, that with the institutional investor, the number of companies has been listed, has been increased, and adding more diversification and option for the market. And that add more under valuation to the Saudi market. Correlated either with the vision projects that we could see year 21 and year afters, the visions projects has been progress. Finally, either with, we can't actually ignore I forgot talking about Expo project that might add millions of arrivals. According to our calculation on Rajhi, we're believing that 40 million, but foreign direct visitor might reach 7.5 million. And that's adding more to the consumer, to the economy. The renewable energy business in Saudi Arabia is progressing, and according to the previous, to the first plan, that Saudi Arabia will have 58 renewable giga, and might goes up to 100, might revise it upside to 100. The digitalization in the economy is progressing. Logistic, all of that had add more valuation, and market try to price it. And we see the companies related to renewable energy and data had exceed the market by almost 100 or 200%. If we look to number of companies that entered the market, 328, and the Saudi market year 23 had made about 14% return. But if we look to companies had beat the market, are about 110 company. They had beat the market, if we exclude banks. So that rising question, the Saudi market, it's need to be looked as it more as a active, managed more on active as passive. The relative, I'm hearing so many debate that emerging market is usually low, the performance of it is most flat. And emerging and reward market or the advanced market, global market is actually you can follow it in passive. And the level of Saudi market give it more correlated or give it more character to the global market that could be followed past. I think this is not right. I think it should be followed in active manner, and the progress happened just in the last 2 years. A number of companies that beating the market is actually more than 34%. That's not need to be considered. And we have a 2 type of action of active and management, which is the discretionary plus the quant. I think the quant is progressing in our environment, but it's still early to depend on it. Or I think the way it will be limited for a reason. It's the relations between elements are changing, and the macro factor. And for example, 2000. If we take a correlation between Saudi and oil market in between 2010, 2014, or 15 or 16, you will find it range between 60 to 70% with the oil market. Now we could see it as, we didn't see actually the effect in year 23, oil market and so the oil and Saudi market. Yani Q3 was one of the best, Q2 one was the best quarters in Saudi, last year in the Saudi market. Well, oil price was falling. Q3 oil prices has progressed, but the Saudi market had correct. So one of important factors, which is oil price, the correlation has been actually falling relative to the Saudi market. Either the correlation between companies, the correlation between major factors. So back again, I hope actually to reach my conclusion, are we trusting equity or bond market? And if we are trusting equity, how should we stay in equity, active or passive, and what gender of equity, and what year 24 is holding for us? I hope we see you next year, and market beat our all expectations and things better than what we predict. Thanks.
Thank you, Mr. Mazen. That was very insightful. Please help me welcome from Morgan Stanley, Mr. Rajiv Sibal.
Good morning, everyone. Thank you to the conference organizers for having me here to speak and having Morgan Stanley have the opportunity to present our economic views. My name is Rajiv Sibal. I sit in the global economics team. I work with Seth Carpenter, who's our chief global economist in New York. I'm based in Dubai, and together we kind of manage our economics forecasts around the world. As I think about the conversations I've been having with clients over the past few months, every single one comes back to the Federal Reserve. And so like my colleague before and like a few of my colleagues later, I think we'll all be sharing a little bit about our views of the Federal Reserve. I go back to kind of the September, October timeframe. One of the benefits I have of sitting in the seat that I do is I get to travel the world and I meet investors in places as far as Sydney to New York, London, Hong Kong. And I remember sitting in client meetings in September and October. I would be at a client dinner, a client roundtable, and almost every single person at the table would tell me that the Fed may not be able to cut interest rates in 2024. At that point in time, the narrative in the market was that inflation was going to continue to accelerate. If you remember, the 10-year bond was hovering near 5%. And people were thinking that the Fed would have to hike even beyond expectations in 2024. If we fast forward, when I did those same circuit of meetings in January this year, I was on the road for about 3 or 4 weeks in January, those same clients that I see a couple times a year were telling me that instead the Fed was going to cut 50 basis points in March. The Morgan Stanley call for a long time has been that the Fed would start cutting in June, and that we're well on course for our 2-year standing call on a soft landing in the United States. This iteration in market expectations is something that is actually very expected in a soft landing scenario. The volatility of the data is something that is part and parcel of what we saw in soft landings in the past in the United States. You may be scratching your head, when is the last time the US has ever had a soft landing? The ones that we have had in recent memory, most economic cycles have not really been soft, so to speak. Great financial crisis, for example, was a hard landing, if you will. 1995 and 1996 is another example where the US had a soft landing. Many economists sometimes don't even include this in their comparison set of recessions because it never reached the recession level in the United States. If we go back to the 1995, 1996 example, and we think about the communication that Alan Greenspan was having to the market like Jay Powell, we begin to see a lot of similarities. In 95, 96, Alan Greenspan said, I'm done hiking rates, and I'm going to pause. This is kind of like what we saw with Jay Powell in November last year. Markets ripped for about 6 weeks. Sounds familiar, right? As equity markets ripped, fixed income markets started to price in interest rates cuts very aggressively and very quickly. To their disappointment, Alan Greenspan didn't do anything for 6 months. And then when he was ready to cut, and he communicated that they were about to start moving, rates markets again started pricing 50 basis points cuts quickly and in succession. He didn't actually do that. He did 25 basis point cuts every other meeting. The Morgan Stanley call for some time now has been that after the pivot, we had this call before the pivot, but after the pivot, you add 6 months, you get to the June, that's our first cut, and then we have cuts coming in successive meetings, but only of 25 basis points. The reason for this is the central banks think differently than financial markets. Financial markets want to trade an economic cycle. They want to see the oscillation of the growth and the deceleration, and they assume that that is going to lead to a weaker economy and potentially recession. What we see in a soft landing scenario is that the pace of that deceleration is very slow. And so you begin to have a lot of volatility in the data. The reason that we had a June call on last year is because in our financial models, inflation was going to reaccelerate in January, February, March, and April, before stabilizing in May. That reacceleration is very light. It's very moderate. We saw the first sense of that in that surprise that we got in CPI last week. That inflation acceleration is changing the 3-month moving average, but not changing the overall narrative that inflation will end the year lower than it began the year. So for financial markets, they see kind of the path and they see where the year would likely end, and so the thought was, let's go ahead and start pricing in cuts. If the Fed doesn't cut, real rates might be too high in the middle of the year. But for the central bank, they have to be a little bit more cautious than that, because labor markets in the United States are really, really tight. And so whenever they see non-farm payrolls surprise to the upside, they begin to think about, well, if the US economy is in full employment, what are the risks that this drives excess demand and keeps inflation higher for longer? This is the way that the central bank thinks. They think in 3-month moving increments rather than single data points. And so for us, that's the big reason why we have a much slower path for the Federal Reserve. And I think this has implications for financial assets around the world. We've seen in equities, we've seen the headline rise, but that belies what's happening under the surface, because every time the rates market pushes out expectations or pulls expectations forward, we begin to see factor rotations within the equities market. And that factor rotation is really hard to trade. And so even though everything seems like everything is okay on the surface, we think that for financial market participants, it's been difficult for the first couple months of the year, particularly on the rate side, but also on the equity side, because of this change in expectations. And unfortunately, we think this is going to persist for a few more months. As I mentioned before, even last year, our inflation model showed a light acceleration in inflation, just a slight lift up for the next few months before settling back down and getting to a place that the Federal Reserve should feel comfortable to start cutting in June. But even then, the pace of cuts is very gradual. We have 100 basis points of cuts on our forecast model in the second half of this year, and then that carries on next year. But that easing financial conditions may only play out in the second half of the year, and I think this is an important thing to consider for emerging market economies, for European economies, for the Japanese economy, for global economies, because a delay in kind of the timing of financial easing challenges what we've seen in equity markets in the past 2 or 3 months. I think equity markets have all risen broadly in anticipation of the Fed cut. And now the question becomes, how sustainable is that? And we're not saying that growth is going to come off too strongly in the US, but we're saying the growth should continue to lightly decelerate. And that growth deceleration is what will enable the inflation to come down and then ease financial conditions in the second half of the year. The one economy, however, that has not seen a reflation in its equity market is China. China is continuing to make policy initiatives to try and put support underneath the equity market. We saw today, this morning, that they made policy cuts. This is just one step of a broader framework of policy initiatives that we think the Chinese have to implement in order to get out of the risk of a debt deflation cycle. I think a lot of investors that I speak to have seen what has happened in the US, they've seen what's happened in China, and so therefore they've been reallocating a lot of their emerging market assets outside of China into new markets. Sometimes that's gone to developed markets like Japan, sometimes that's gone to markets like India, and a lot of times that's come to markets like Saudi Arabia. And I think this is a unique opportunity because you see the exciting reforms that are happening in this market. We saw just earlier in the presentation some of the capital market developments that are happening here. This presents a huge opportunity for the domestic market to continue to expand as they have in the past, given some of the changes that are happening in emerging markets more generally. Continuing on outside of emerging markets, moving to Japan, as we kind of finish our around the world tour in the last couple minutes of my presentation here. In Japan, we have a call that the BOJ has had a structural shift in the Japanese economy that will enable them to come out of yield curve control and negative interest rate policy in March with risks to April. Japan normalizing policy is a big, big deal. It's important because Japan has been in a semi-deflationary environment for a very long time. And what we believe we're beginning to see is the onset of structural change in nominal growth in Japan, and inflation being sustainably above 0%, closer to 1 to 2%, something that we have not seen for a long time. This will change the global investment landscape. And it's important particularly right now because as I think about all that capital inflow into Saudi and into other emerging markets generally, the balance of the BOJ, the ECB, and the Federal Reserve become critically important as we think about the value of the dollar. We've seen the dollar have a nice little move in the first couple months of this year. That's been as the Fed expectations have been pushed out from that March timeframe, as I talked about at the beginning. Now that we're pricing in June, which is in line with our call, we think that the dollar has kind of found its neutralized territory. And with a more stable dollar, it creates a more conducive investment environment once we settle on what the growth outlook is likely to be in the next few months and next few quarters. The challenge is that over the time frame until the Fed actually starts cutting, it's going to be choppy and noisy. And we think the pattern of lower interest rates in the US only starts in the second half of the year, which is what creates propagation elsewhere in other global financial markets. I think as I speak with investors globally, this time period has been particularly challenging, but I just want to conclude by highlighting that this isn't the first time this has happened in the United States. And what is different is that other global markets are structured differently than they were in 1995 and 1996 in the US. Emerging markets are in a much better place, both from a monetary policy standpoint and from a fiscal policy standpoint. Japan now looks like it's exiting a deflationary environment. And Europe actually looks like it might be turning the corner in this summer as well. And so the global environment is different than 95, 96. I don't want to have comparisons made to some of the financial crises that came in the late 1990s. But I do think from a US domestic perspective, and as we think about what this means for federal funds rates and for the US dollar globally, the 1995-1996 comparison is really relevant and really interesting because, like I said, we had the pivot in 95-96. We didn't have a cut for 6 months as data was volatile but slowly trending down. And then when we did have cuts, it was very gradual and in successive meetings rather than every single meeting. This is what our call is at Morgan Stanley for the Fed for this year. We have a cut priced in June and then slow cuts in every other meeting thereafter. We think that this is important for investors, and we think that this is kind of the framework we need to have this year, is that the trend will start in the second half of the year in terms of the rates market and in terms of the understanding where growth will settle in the United States. So I will conclude my presentation there a couple minutes early, but thank you for your time, and I will, I guess, hand it back over to the MC. Thank you.
Thank you, Mr. Rajiv. From Goldman Sachs, please help me welcome Mr. Walid Mohsen. Mr. Walid, please make your way to the stage.
Good morning, Assalamu alaikum. It's a pleasure to be here. For the next 15 minutes, I have two goals. Number one, to talk about a global macro forecast, and number two, to keep you guys engaged, keep you all engaged. So 5 key topics I want to focus on for today's discussion. The first is global growth, the second being interest rates, the third being oil prices and the US dollar, and finally, Saudi capital markets transformation. So linking it all back. If you think about the global economy, it has been unbelievably resilient, extremely resilient. If you think about the last couple of years, let's think bank failures, let's think geopolitical risks, interest rates going up by more than 500 basis points, number of global elections. Despite that, the global economy has been quite resilient. And the good news that I would share with you is that our global forecast for global growth sits at 2.8% for 2024, which is well above consensus of 2.2%. So what makes us optimistic about global growth? Number one, we believe that real disposable income will recover, especially as inflation headwinds fall. And number two, linked to this, we also have a relatively strong labor market. And as such, we believe that real disposable income will continue to increase. Secondly, we expect manufacturing activity to recover. The third point I would make is that interest rate headwinds will fade. Now, we always get this question, how much time do interest rates take in terms of transmission into the economy? Our analysis suggests that within 2 quarters, the impact of rates feeds into the economy. So as a result, the rate hikes we've seen in 2023 have already transmissioned into the economy. And the other reason for optimism is that if you look at the central banks, there seems to be more willingness to support growth, and we feel this is more like an insurance to avoiding a recession. And our past analysis suggests that when inflation falls below 3% or at 3%, the propensity of central banks to cut is 2 times higher versus if inflation is sitting at around 5%. So now talking about some of the larger economies globally, I started with the view that we are constructive on global growth. We're equally constructive on US growth, and we sit above consensus. We have around 2.4% GDP growth forecast. And again, it's dependent on a recovering labor market, real disposable income recovering, and inflation headwinds and interest rate headwinds falling off. If we talk about the Eurozone, we expect 0.5% GDP growth. So we think some of the drags in 2023 will fade in 2024. So we're constructive there as well. China is a key topic. And we do expect some slowdown in GDP growth in China, but we still expect around 4.8% GDP growth. Some of the easy wins in China from the reopening have subsided. However, we do believe that some of the policy stimulus will still keep GDP growth relatively okay at 4.8%. In the broader context of EM, we are slightly above consensus on the CEMEA markets. We are slightly more constructive on Asia, excluding China. And we're broadly in line with consensus on the Latin American markets. India, we expect roughly 6% GDP growth. And for Saudi Arabia, we expect around 5% GDP growth, mostly led by non-oil GDP growth. So that's the first point. I hope I've been able to share some optimism with you regarding global growth. So I'll transition to interest rates, a highly debated topic. I mean, if you talk about third quarter last year, we could have said the market wasn't expecting much rate cuts. And then we had a quick pivot whereby the market was expecting at some point more than 7 rate cuts. We're back to around 4 rate cuts at this moment. And what we expect this year in the US is 5 rate cuts, 25 basis points each, and then 3 rate cuts in 2025. And we believe that the Fed hiking rate cycle is done. So overall, we expect 200 basis points of rate cuts into 2025. Similarly, if we kind of think about our view on different markets, we expect around 225 basis points of cumulative rate cuts from the Bank of England. And in the case of ECB, we expect 175 basis points of cumulative rate cuts. So the picture I'm painting is that we believe that rates will come off, and this will be supportive for the economy. Obviously, with Saudi, we expect monetary policy to remain tied to the US, and no surprises over there on that front. So I presented the global growth. I presented the rates picture, and then takes me to the other topic on US dollar. And so far, what I've said would probably make you think that we are perhaps overly bearish on the US dollar, given what I've talked about. However, we only expect a modest depreciation of the US dollar, which is a little bit at odds with the rate cycle that I talked about. And the reason for that is the first point on growth. We still expect relatively robust growth in the US. And our above consensus forecast on global growth is largely dependent on the US. And as such, we expect only modest depreciation of the US dollar, despite the fact that on a trade-weighted basis, it looks slightly overvalued. Now, if we add into the mix our constructive view on risk, and I talked about our emerging market growth expectations, we do think that there is the pro-cyclical set of currencies which can actually strengthen against the US dollar in the short to medium term. Which currencies are we thinking here? In the G10 space, we think about the GBP. We think there's room for it to strengthen. And within the EM space, I would highlight the Brazilian real, the Korean won, the Polish zloty, and the Indonesian rupiah. So that's where we actually expect some appreciation against the US dollar. So, from a currency perspective, obviously, a US dollar, which is modestly weaker, is supportive for EM and also supportive for EM equity risk. So, linking all three that I've talked about, I'll transition to another topic which is widely debated, and we can have no conversation in the Middle East without talking about oil prices. And despite sharing a lot of optimism on global growth, what I would say on oil prices is that we expect oil prices to be relatively range-bound. Our 6-month out oil price forecast for the Brent is $85 per barrel, which is a modest appreciation from where we are today. And the reason why we actually expect oil to remain range-bound is because of two reasons. On one end, you've got OPEC Plus keeping supply in check. We've also got relatively modest recession risk, as I talked about in terms of a global growth forecast. Our estimate of the US economy going into a recession is only 15%, one of the lowest amongst consensus. So these are a couple of positive factors for oil prices. However, on the other side, we must note that there's spare capacity available. We also note, as we talked about China, we expect growth to slow down. So if you put both of these together, that drives our relatively range-bound expectations on oil prices. A question we get is, what if China's growth disappoints further? It's clearly a downside risk to oil prices. At the same time, we also note tactically that the US and China have been opportunistically doing SPR purchases, which is supportive. And then lastly, obviously, geopolitical risks can add upside risk to oil prices. Now, what does an $85 per barrel oil price mean for the region? And more specifically for Saudi Arabia. If you look at various forecasts for Saudi Arabia's budget break-even, they typically sit in the mid to high 80s, which means that our oil price forecast of around $85 per barrel for the next 6 months means perhaps little opportunity for a fiscal surplus, but perhaps a small deficit or relatively flat budget. However, we would like to add to the mix the mega project spending that Saudi Arabia is doing, which sits outside this budget. So if you add that into the mix, it's likely that Saudi Arabia will need to finance these projects from various sources of funding. So while the oil price backdrop is supportive, as it will not lead to a large fiscal deficit on the budget as usual, however, the mega project spending would need financing requirements. So how would this be funded? And why did we decide to, kind of the 4 global points I talked about, why did I think about throwing Saudi capital markets transformation into the mix? We think as Saudi delivers on Vision 2030, the capital markets will undergo a massive transformation. And what do I mean by that? We think equity capital markets are undergoing a massive transformation because the funding of these projects will not only be limited to bank debt, as it's been going on recently. It will be a mix of equity, debt, hybrid capital, and other measures as well, such as securitization and secondary market activity. So starting with equity capital markets, our analysis suggests that Middle East can become as large as 10% of the MSCI Emerging Market Index in the medium to long term, making it one of the largest non-Asia EM bloc in the world. Or effectively, you can also say one of the largest EM blocks in the world. Now, currently, investors are underweight the region and Saudi Arabia. Our calculation suggests that if investors were to move to a market weight position, and if the weight that we are actually forecasting, which is 10%, is correct, this can unlock $50 billion of active and passive flows into the equity market. Now, why is this important? As we think about monetization of assets, new listings, placements, all of this will be a key driver absorbing that liquidity. So we think equity market development is crucial to financing some of these projects. The other topic, which is getting a lot of traction more recently, is debt capital market development. And on that point, what I would note is that if you think about the the corporate debt capital market penetration in the G20 countries, it's 40%. You'll be surprised that the number for Saudi sits at 4%. So almost 1/10 penetration. Another interesting stat I'll share with you, if you look at financing of corporate borrowings globally, in the case of Europe, only 50% of corporate borrowings are funded by banks. In the US, this number is as low as 25%. However, for Saudi Arabia, this number is more than 75%. So clearly, there has been an uneven reliance on bank debt to fund these projects. So we think debt capital markets will develop. Now, to give you some numbers on the quantum of financing, just if you look at the banking system, we believe that over the next 2 to 3 years, there could be more than $30 billion of issuances just from the Saudi banks. Now, if you throw sovereigns and corporates into the mix, this can be a multiplier of this. In fact, some of the data points from the Ministry of Investment shows that financing requirements will grow at 14–15%, whereas the availability of financing supply will grow at around 8–9%, which will create an almost 6% gap per year in terms of financing requirements. And how will this be funded? We think through a multitude of financing factors. Equity capital markets is talked about, debt capital markets is the other, and then a development of a secondary market. We still do not have a secondary loan distribution market. Securitization is in its early stages. All of this, in our view, makes it quite excited and optimistic about the development of the capital markets. We believe the transformation is already underway. However, there is more which will happen over the next few years as Saudi continues to deliver on Vision 2030 related projects. So just to kind of wrap it up and put everything together, the 5 points I made. Number one, we're constructive on global growth, where we're above consensus. So, reason to be optimistic on global growth. Number two, on interest rates, we think that the headwinds are behind us, and it took 2 quarters to absorb the more recent rate hikes, which are already in the price. And as such, headwinds will potentially become tailwinds. The US dollar should not be a headwind for EM and for the global economy, with modest depreciation expectations. Oil prices, I hope I was more optimistic and would have given you a more bullish picture, but still a relatively okay picture, whereby we expect oil prices to remain range-bound. And finally, something which we're extremely excited about is the capital markets transformation, where the 2 numbers I will leave with you is $50 billion of potential equity inflows and 10% potential weight in EM in the medium to long term, potentially making the region one of the largest in EM. I will leave it there. Thank you much.
Thank you, Mr. Walid. I would like to present the next speaker, Mr. Luis Oganes from JP Morgan. Mr. Luis, please make your way to the stage.
Sabah al-Khair wa marhaba bikum. Very nice to be here. Thank you to the Saudi Capital Markets Forum for inviting me to speak here and share some of the views that we are managing these days. Certainly a lot of uncertainty, generally speaking, and a bit of a roller coaster ride, both for those like me that try to forecast the future, and of course for capital markets that try to price in whatever new data comes out. We spent last year going from a narrative of, is the US economy after 500 basis points of tightening going into a recession, or is it just going to be a soft landing? And the market has started to go up and down based on the expectation of what could be the base case scenario for the economy. I would say that by the end of the year, early this year, the consensus seemed to have gravitated towards a soft landing, which is still where we are right now. But what is interesting is that the data flow in the US in the last couple of weeks that came out more on the strong side has led to a different discussion, which is, maybe the question whether it's going to be soft landing or hard landing is the wrong question. Maybe the question is, are we going to see no landing, meaning that the US remains quite resilient, and therefore the labor market remains quite tight, and therefore inflation pressures coming from wages will remain strong, and the Fed would not have the room to cut. So this is what has been happening in the last couple of weeks. Certainly last week, the release of the CPI was a reminder that the fight against inflation is clearly not over. And the last leg of disinflation, we were at 5–6%, now we're at 3%. Going to 2%, which is the target, is going to be possibly the most difficult portion of the disinflation process of the anti-inflation fight. So the question here is, okay, if there is no landing, does that mean that the Fed won't cut rates? And the first message that I want to deliver to you is that we think that they will cut rates regardless meaning that even if there's no soft landing, even if inflation remains around 3%, there is room to cut. Why so? Because when you look at the policy rate in the US, the Fed funds rate, which is at 5.5%, and you compare to the inflation number, which is around 3 right now, sake of argument, let's assume that the 3% stays constant until the end of the year, that there is no further weakening the labor market, and therefore the Fed, the wage pressures continue, and that this inflation stalls, inflation remains quite sticky at 3%. If you compare the policy rate 5.5 with inflation at 3%, that is already 2.5% of a real policy rate. And you compare this to what we estimate to be the potential growth rate of the US economy, which is 1.5, if you want to be generous, maybe 1.75%. And you compare the real policy rate, it is quite restrictive already. So if the Fed were to leave the policy rate this restrictive until the end of the year, you could almost be guaranteed that next year it would literally be pushing the brakes on growth, and next year we would have a recession. And remember, the Fed, compared to the ECB or the Bank of England, has two mandates, to fight inflation, but also to preserve growth. So the conditions we think are there for at some point in the year for the Fed to start cutting. The question is when, and of course how much. The when we think is going to be around mid-year. I heard my previous speakers saying something similar. Our base case scenario is that the Fed is going to start cutting in June. Certainly, the market has been taking a bit more of a conservative stance of late because of the CPI print being so strong last week. But let's just remember, between now and June, which is when we expect the first cut, we still have 3 CPI data releases. We still have 4 labor market prints. So there's ample room for inflation to hopefully start converging a bit lower, and for the labor market to start showing some weakness and not generate this anxiety that, hey, maybe the Fed doesn't have room to cut. So the base case scenario, Fed starts in June, cuts each meeting the remainder of the year. That will be 125 basis points cumulative cuts in the second half of this year. There's another 50 basis points coming in the first quarter of next year. That would be cumulative 174 basis points of cuts between now and March 2025. Risks clearly are for less rather than more. So I think that the next couple of months of data are going to be quite important for all of us to follow. February CPI, if it is once again strong, CPI, generally speaking, January CPI numbers tend to be quite volatile. So if February confirms that there is still pricing power, there is still pricing momentum, maybe that is the moment where the market starts to even take off, fully June or July from the projections, and maybe our own economists decide to also remove that from the forecast. But we're not there yet, so I guess we have to just be patient. So let's compare now the US situation with Europe so that we can have a comment on exchange rates. Europe has been avoiding recession, which is obviously good news, but the momentum clearly is much weaker. It's being above 0, but barely so. We had a confirmation in the UK that the UK did fall into technical recession in the last 2 quarters of second half of last year. In the Eurozone, that has not been the case, but certainly the situation is a lot more complicated. Part of it is the issues with energy. Part of it is the fact that you don't have the same type of productivity gain that you have had in the US. Certainly, you have not had the policy stimulus from the fiscal side that you are still seeing in the US, et cetera, et cetera. So the forecast for the Eurozone, for the ECB, is that they also start cutting in June, similar to the Fed. The cumulative for the second half of the year is 4 cuts, bringing the policy rate from 4 to 3%, another 50 basis points as well in the first quarter of next year. So if you compare the path for policies in the base case scenario that we have, Fed and ECB, you have 175 basis points cumulative for the Fed, 150 for ECB. So the differential, the yield differential, the interest rate differential, in principle should not be changing so much. But as I said before, the risks around the Fed is that they do less, and possibly because of growth momentum being much weaker, the risks around the ECB is that they actually may need, once they get going, may need to do more. So there is the possibility that the yield differential or interest rate differential starts to widen between the two, and that would favor the dollar. So that is one argument for expecting dollar strength versus the euro. The other one is obviously the differential in growth momentum. I already mentioned growth momentum in the US is strong, growth momentum in Europe weaker, so that also should be favoring the dollar. We have a forecast of 103, 105 for the middle of the year. For second half of the year, this could be continued if there is, let's say, no landing and that the Fed does less, but that remains to be seen. A third, again, that speaks for continued dollar strength. We don't have, some people are thinking that there could be actually a move towards parity in euro-dollar. That is clearly not our base case scenario. For parity to be reached between the euro and the dollar, you probably need to have, well, maybe no landing in the US and maybe a recession in Europe that forces the ECB to cut more, and maybe that pushes the currency towards parity, which again is not our base case, so we don't have that in our forecast, but the probability of that certainly is not zero. One third element that can shape what may happen in the currencies is the US elections, and as you know, a lot of the debate is pointing to more isolationist policies from the US, the adoption of more aggressive tariffs and the like. If that was to be the case after the elections, certainly that could also spell more strength, at least in the short term, for the dollar, so something to watch. Quickly, let me shift to the oil market, which is very important for Saudi Arabia and for this part of the world in general. As was mentioned earlier, we do agree that the demand picture looks still quite healthy, despite the fact that you have China disappointing in growth. The demand for China is still quite strong, partly because they're building strategic reserves, partly because there is pent-up demand coming from the fact that the process of normalization post-reopening is still incomplete. Just to give you 2 data points, which are very interesting. If you look at the number of non-stop flights between the US and China, right now it stands only at 20% of 2019 levels. In the case of non-stop flights between China and Europe is 60% of 2019 levels. Domestic flights in China have already returned to 2019 levels, so there's been normalization. So there's still, more of pent-up demand that is going to be coming from the normalization process, going back to pre-pandemic or close to pre-pandemic levels, that will probably keep supporting the demand side. The issues have been more on the supply side. We have seen quite a big increase of non-OPEC supply that has been forcing OPEC countries, including Saudi Arabia, to cut production in an effort to try to balance the market. They accomplished that last year. Given the extension of these production cuts, we think that the market this year is still going to be balanced. The forecast that we have for Brent is an average of $83 per barrel, which is similar to the 2023 average. I think that the question mark is more on the 2025 outlook, because by then maybe this normalization, this pent-up demand that I mentioned from China is going to be a lot more mature, so maybe the demand from China is going to decline. In the US, we don't know if it's recession, if it's soft landing, but generally speaking, points to some moderation of growth, which also would spell, maybe lower demand. So the question, and the non-OPEC countries, you know, the US shale oil, and Brazil, and Suriname, and Guyana, all these countries that have been ramping up production will probably continue next year. So the question for 2025 is, okay, how can we balance the market? Whether OPEC is going to be either able or willing to keep ceding market share in order to keep things balanced. So our forecast is for oil prices next year to average 75. Now, 75 is not a bad number. It is still above when you start, you know, just trying to land all of this to what it means for Saudi Arabia. We estimate that the break-even from the budget point of view in Saudi is around $90 per barrel. So being at 83, which has been last year or this year, that means a fiscal deficit. Last year, we just got a confirmation it was 2%. We have something similar, I believe 1.9% for this year in our projections. But if oil prices go down to 75, which is the forecast for 2025, and there's no a reduction in spending, which we're not hearing that that's in the cards, the fiscal deficit will probably be larger, maybe getting to 3% of GDP next year. The corollary of this, though, is that you know, Saudi is going to well, they already Saudi Arabia started to become have more important presence in the global capital markets, issuing hard currency bonds. Already, even so far in 2024, there's been $12 billion of issuance. We have seen the market responding quite positively, right, that this issuance was oversubscribed, and that is expectation that we have. You know, it's a newcomer to the market, the more the merrier. Now that the Fed starts to cut, we think that there's going to be more capital coming to emerging markets, so it's going to be a good environment to place debt. But you know, the one thing that possibly Saudi Arabia should try to take advantage is that as its financing needs will probably remain strong in the years ahead, given the transformation that the economy, that the investments that are needed for the transformation of the economy, that more effort is made to try to develop the domestic capital market, in SAR. There is clearly a lot of plans about that. Eventually, there's a possibility that foreigners also start to tap into the domestic market, and I think that the strategy should be, which is what we have seen in other emerging market economies, try to diversify your funding sources as much as possible. We see it as a positive to have a newcomer, active issuer in the market. As I said before, the Fed cuts should spell a return of capital flows into EM fixed income, which were absent in the last couple of years when the Fed was keeping rates so high. So from that perspective, there's the moment for a stronger presence of Saudi Arabia in the international debt market should be a good one, should be helped by the fact that interest rates are on their way down. Further out, hopefully, obviously, all these investments start to bear fruit, growth remains strong, so everyone is going to be watching the debt to GDP dynamics. But again, I think that the investments that are taking place here will probably preserve growth at an accelerating and a healthy pace, so the debt to GDP at this stage is not something that is a concern for markets or should be a concern here. And hopefully what we will see in the coming years is a deepening of the domestic capital market, so that corporates can increasingly depend more on the domestic market as opposed to having to go outside to borrow. Let me stop here. Thank you so much for listening. Thanks. Shukran.
Thank you, Mr. Luis. Please help me welcome our final speaker for the economic sprint, Mr. Ahmed Shamsuddin from EFG Hermes. Mr. Ahmed, please make your way to the stage.
Bismillah ar-Rahman ar-Rahim. Good morning, ladies and gentlemen. It's a great pleasure to be part of your program today. My name is Ahmed Shams. I head the global research at EFG Hermes. I was actually planning to spend a few minutes talking about the global economy, rates, China, US, oil, but I think these topics are very well covered by my colleagues. So I'm going to focus on Saudi-specific issues, which I think could enrich the discussion and add some value to my talk here. So from a Saudi perspective, the equity market has been doing great. And from a foreign institutional investor's perspective, it took everyone by surprise. Let me tell you that Saudi is 4.5% of the benchmark in the emerging market indices. And the actual ownership is still only 1.5% or less. And the reason behind this is maybe valuation. Maybe the model is, let me put it this way, maybe it's too good to be true for equity investors. Maybe growth cannot be priced in the financial models. There are a lot of reasons why is this, but what we know for a fact is that Saudi is under-owned from an active institutional investor's perspective, although that the potential is great. And I'm going to spend the few minutes of my talk talking about this and how institutional investors, whether from the equity side or the debt side or the fixed income side, would look at the Saudi market given the transformation that we are seeing and given the huge potential this country is offering for investments. I covered Saudi since 2006. I'm still very young. I put on some weight, but doesn't mean that I'm getting older. And I can tell you, I can safely claim that this is a completely new country. And the way that we are modeling, even at the micro level, the way we are modeling companies, stocks, sukuks, all the assets valuations have been changing. And the reason is the structural change on the ground is taking everyone by surprise, not only at the level of the size, but also at the level of the time span this change has been taking place. So why Saudi is under-owned? And this will bring me to a very critical question that we are always getting from institutional investors, particularly foreign institutional investors at EFGMS. How Saudi is going to fund such an aggressive, unprecedented investment program? How is this possible? I mean, we know at the current oil prices, the budget is already in deficit. Yes, it's a small deficit, 1.5% of the GDP, but there's no room at the level of the budget. And the magic answer that we get and we hear from our counterparts and market participants is PIF, which is partly true. PIF is one of the largest sovereign wealth funds. It has an international reach. It's a very big size, and it can actually rechannel liquidities into the domestic economy. Absolutely. Not only the liquidity, but it can also invest and co-invest and boost the FDIs into the country. But this is not enough. If we're talking about $3 trillion, this is around 3 times as big as the net foreign assets in Saudi and the sovereign wealth fund size combined. So another answer is Saudi can borrow. The borrowing capacity of Saudi Arabia is very strong. Obviously, the country has a low credit penetration from a financial market point of view. Debt to GDP is barely at 25%. It can easily double this, and it will remain very competitive globally. So there is a strong borrowing capacity for Saudi, which is also true. But this top-down model, when we come about funding projects, is changing or has to change because this is not priced into the Saudi model from a financial markets perspective. And the reason is, if we're talking about economic growth, diversification, less reliance on oil revenues, these projects are amazing. But to have this materializing on the ground, we have to talk about financial agility, and we have to convince ourselves and convince foreign institutional investors that this is changing on the ground by leveraging all the aspects of the financial system and decentralizing the funding sources. This is one challenges that are facing Saudi right now, or facing the perception of the Saudi investment in the minds and the models of the financial institutions. And how is this related to investing in equity and debt market? I'll come to that in a bit. So basically, if we're talking about decentralizing the funding resources in Saudi Arabia, this is very important when it comes to borrowing costs, building a local yield curve, and this will also have an impact on the valuation of the equity market as we go through the implementation of the various projects in the economy. The banking sector is already, in terms of the liquidity, is stretched. Not to the maximum, but it's stretched. If you look at the banking sector liquidity, there is not much to be delivered in terms of, credit growth has been outpacing growth in deposits for years now. And loan-to-deposit ratio is very high in the country. Although credit penetration is part of as a percentage of the GDP is low, but the banking sector liquidity cannot do much. Yes, banks in Saudi are very well funded, very strong, but alone, the financial sector and the banks actually in particular cannot be the engine to fund such an aggressive investment program. The outlook for oil, I mean, I'll not repeat what my colleagues have actually said, but the outlook for oil is not, yes, I share with my friend Mazen Suderi and most of the speakers that the downside is limited, not limited from the current level, but in the next cycle, if we're talking about a mild recession, if we're talking about some economic adjustment that might take place in the next cycle, the oil price will be much higher than its bottom in the last cycle. So I agree that the downside in the next recession will not be as big. The oil market remains very well balanced, but the upside is not there as well. And the reason is the energy independency in the US, shale, this was very well covered, China, the structural issues in China, the policy dilemma in China, which will actually act as an overhang on all commodities. So basically, we're talking about banking sector stretched, and here comes the sleeping giant, which is the debt capital market. I was very happy to see this point tackled many times in the opening session of this conference. This is very important in the decentralization of funding options, and this is very important in pricing the risk and the reward for institutional investors, whether locally, regionally, or internationally. Debt market in Saudi is still lagging behind the equity market. The equity market has made this significant development in the last 6-7 years. Trading rules have changed, access to investors have improved, everything, and Saudi got upgraded, massive improvement and massive transformation. On the debt side, it's still lagging. The number of private issuance, non-sovereign issuance in the debt market in Saudi it doesn't exceed 3-4% of the GDP, compared to 25% average issuance to GDP in the BRICS countries, Brazil, China, India, and compared to 50% in the G20. So improving the debt market will unlock massive funding potential, and it will add more long-term funding resources to the financial sector instead of going to the overseas funding, which is very volatile. So for sustainability of funding, this is very important. It will help us price risk, it will help us price the equity market better, and it will be reflected into a better valuation in the equity market. Building a yield curve a local yield curve in Saudi Riyal is very important for Saudi in the next 5 years. Moving from capital allocation to capital efficiency, I think value creation is a mix of growth, which nobody is doubting in Saudi, and excess returns. And when it comes to excess returns, there are some sectors in Saudi Arabia, I'm talking about listed equities representing different economic sectors, that are not generating enough return on capital from an investment perspective, not from an economic or from an accounting perspective. From a valuation, from a financial perspective, return on capital has been way below the cost of funding or the cost of capital for different sectors. If you look at the return on capital for 5, 6 economic sectors, they are now lower than their 5-year average. And this has to change. And for some sectors, the only way to change this is consolidation. So the second theme that we are seeing materializing in Saudi Arabia is consolidation, vertical consolidation and also horizontal consolidation. And by vertical consolidation, I mean there are some sectors that unorganized players represent 60, 65, even 70% of the market. And if we're talking about Saudi Arabia 5 years down the line, I think this will change. And consolidation also in the sense of if you have fragmented players, all of them are delivering returns below cost of capital, this has to consolidate and has to be national champions in every sector. And this is how we see return on capital converging, returning back to the attractive level. And this will be reflected in a better valuation for the Saudi market. Part of the problem is this sweeping, significant growth is not priced in because the model is, we're buying growth or value. Actually, you're buying both. But there are a lot of corporate transactions and a great deal of consolidation that has to be delivered on the ground in order for the market to deliver and to make sense from a foreign institutional perspective. They've been underweight Saudi for 3 years now because they don't understand the valuation, they don't understand the market. Is it close to Vietnam where growth, exports, strong balance of payment, current account driving liquidity into the market, or this is a value trap where we rechannel too much liquidity in non-tradable sector, which is not the case of Saudi Arabia. So linking capital allocation with capital efficiency is the way forward to see Saudi market getting the right valuation and to capture in the growth from a financial perspective. Saudi has the population growth. It has the productivity gains that we are seeing given the significant investment in technology and the significant expected consolidation in different economic sectors. Linking population growth, young country with productivity gain will pave the way for a completely different picture for the capital market. And by here, I conclude my talk and thank you very much for listening. And I wish you all the best in the next program. Thank you very much.
Thank you, gentlemen, for these fascinating presentations that we hope have served their purpose as being insightful, and we hope it provided you with an overview on various global economic topics. And now we are to head to track 5 with a panel titled Saudi Exchange, the Capital of Capital. We will be hearing from the Deputy of Financing and Investment of the Capital Market Authority, Mr. Abdullah bin Ghannam, the Vice Chairman, UK, Europe, Middle East and Africa Equity Capital Markets of Citigroup, Mr. Ken Robbins, Partner, Co-Head, Global Equity Capital Markets of Rothschild & Co., Ms. Claire Suddens-Spears, Co-Head of EMEA Equity Capital Markets and Co-Head of UK Investment Banking of Goldman Sachs, Mr. Richard Cormack, and CEO of Riyadh Capital, Dr. Abdullah Al-Shwair. This panel will be moderated by the one and only Ms. Vonnie Quinn, Bloomberg First's Words Anchor. Ms. Vonnie, I leave the stage to you.
everybody. I hope we were worth the wait. How's everybody out there? Good? We'll don't all answer at once. All right, panelists, take your seats. I have permission to call Mr. Abdullah, and also Mr. Abdullah. So I'm going to differentiate them by saying, Abdullah from the Capital Market Authority and Abdullah from Riyadh Capital, if that's okay by everybody. Let's get straight into it. We have some time. So if I could start with you, Abdullah, from the Capital Market Authority. Obviously, we've seen a huge amount of development, and there's a lot of excitement. What do you expect the market to look like in 5 years? What's the next big regulatory push from the CMA to get there?
Thank you very much, Bonnie. Good morning, everyone. Let's first reflect on how busy we have been over the last few years and remember how the Saudi capital market around 2014 and 15 was mainly for local investors in cash equities and serving mostly large corporates. So when we wanted to put our strategy back then, we tried to focus on three things. First, we wanted our regulatory ecosystem to be serving the entire life cycle of businesses, from startups up until the growth of large listed companies. So there has been a revamp in companies' law, offering of securities regulations, investment fund regulations, introduction of fintech lab concepts, and therefore you find that the VC and startups funding evolved, and last year Saudi was the #1 country in the region in terms of venture capital deployment. I give some more pieces of data. The AUM in private equity venture capital reached 7 billion assets under management. Today it used to be 13 last year. It is now lower because of exits. Crowdfunding raised around 2.4 billion. And these kind of activities are feeding into the capital market and IPOs. Also, we did introduce the Namu market, and we enhanced the attractiveness of the main market by introducing tradable rights, non-preemptive rights, and enhancing book building process to make it more friendly to issuers and investors. The result is that we have now more than 310 companies listed in both markets compared to less than 170 back then. Also, we focused on expanding the products variety. We introduced REITs, exchange-traded products, derivatives. We enhanced also the DCM market. It has now reached to 124 billion from 22 issuers. Last but not least, we focused on increasing the attractiveness of the Saudi capital market for a wider range of investors and mostly for international investors. And we did it through two things. One, easing the access. We introduced the QFIs, closely communicated with the market, eased the access over the years. We introduced bilingual disclosures, and we also migrated from T+0 to T+2. In addition, there's one more thing very important to attract international investors, that we kept an eye on maintaining confidence in our market. And we did that by continuously keeping our governance regulations up to standards, adopting IFRS a few years ago, and regulating and supervising auditors, focusing in adopting high standards in dealers, brokers. All of that resulted in, as you may know, that the total international investors holding in the Saudi capital market is around 400 Saudi riyal. And if I link it to our topic today, last year, the demand for subscription in IPOs from international investors was in excess of 70 billion Saudi riyal, which is more than the offerings themselves. Of course, the allocation was less than that number because of the higher demand from local investors. But this is a very important signal of how opening up is serving the raise of capital. Going back to the focus in the future, as His Excellency mentioned yesterday, debt capital market is #1 priority. Today, it is around 4% of GDP, and the target is to take it up until 18, which is around 7 or 9 folds, taking into consideration the growth in GDP. Second, we are focusing on growing asset management industry. It is around 19% today of GDP. The target is to take it more than 28, and it is a very important catalyst for capital raising and for efficient allocation of capital. Also, we are focusing in adopting new tools for growth in the capital market and for businesses. For example, we are gradually introducing SPACs. Also, we are introducing the offering of multiple shares of classes. And we are enhancing the tools in M&As to help companies grow inside the kingdom and beyond borders. And soon we will be publishing our strategy that is showing all our targets in these areas.
We definitely want to come back to some of those points that you mentioned, including the debt capital markets. I know that both you and Abdullah from Riyadh Capital were involved in building out the yield curve back in the late 2017, 18, those years. But just to focus a little bit on the ebullience that we're seeing in this market right now. Claire, I know, between the panelists, you've been coming here for several decades. But Claire, you said that this actually reminds you of the Asian tigers, that time frame, and that nothing had reminded you of that since. Explain a little more what you mean.
So look, I have the benefit of looking at equity capital markets globally, and it's not a coincidence that you see the three of us here who spend an awful lot of our time, despite having a much bigger role than just the region, that we spend a genuine amount of our time here. There is a real excitement in terms of what is now happening in the Middle East, but specifically in the Saudi market. As Abdullah has just outlined, there is an awful lot of development that is happening, that has already happened. So, when we talk about the title of this panel, the capital of capital, the world is watching, and the world is paying attention, and more importantly, participating in what we're seeing now as a real sustained growth in terms of the market in this region.
Well, and as you were saying, IPOs have been extraordinarily successful, which is a virtuous cycle. It can have its faults. But Richard, what are the fragilities that you see in this market that perhaps would concern you?
Yeah, it's a good question. I don't think we see fragilities per se. I think the market has grown in a very robust manner, and it's grown from the fact that it has a very strong domestic investor base, both retail and a growing domestic asset management base. I think the kind of regulatory framework that the CMA has put in has been very strong, and has obviously encouraged issuers to come to market, and that has worked extremely well. I think if you ask me what's my biggest concern from a fragility perspective, it's probably that we get overexcited and we have some deals that don't work. We've had the benefit here of just a string of transactions that have been successfully priced for the issuer and worked extremely well for the investor. So if you look at the average performance of IPOs last year, they were up nearly 40% on day one, up nearly 70% over a kind of 1 month period. And that encourages, obviously, investors to want to participate in the next IPO and the next IPO. If that cycle gets broken, and we have seen that break in other markets, it broke in Asia at a point in time, then the kind of continued enthusiasm could get dented, at least temporarily, and then it needs to rebuild itself. I don't worry about that as a structural fragility. I worry more of there being a cyclical fragility at a point in time. We've had very secular growth in this market. At some point, you could see that having a pause.
Ken, Could that be avoided? Is there a way for the market to sort of correctly price itself and self-correct at a point in time if there is too much ebullience?
Well, look, I think as Richard says, there's always a risk that someone tries and pushes price too high. And right now, as we've heard, we've had a huge number of successful offerings. But I think, as I said, and as Richard said, that's not a structural element. That's just ultimately will almost definitely happen at some point in any capital market. I think what's really interesting here, as we sit here today at least, is that not only are there a lot of IPOs and a very strong pipeline, if we look at it relatively versus the rest of the world, I mean, the rest of the world just coming out of a very significant change in the cost of capital, which has made the IPO market very, very challenging. We've only really just started to see it reopen in the US and in Europe, except a couple of major transactions last year. So on a relative basis, when investors are looking to put money to work in new transactions, this region has really been one of the few places to go. And that's A, it's exciting, but B, it offers obviously investors a perspective in terms of different macro. But it also, I think, and this is what we'd like to see further develop in the market, and we are confident it will do, is we want to see further diversity of sectors. So clearly, to date, the local market is very dominated by petrochem, by banks, and by real estate. But we're encouraged by the fact our pipeline is building in consumer, in tech, in fintech, and these sorts of sectors, I think, are really exciting for investors because obviously they offer more growth on top of the already encouraging growth we're seeing in this marketplace today. And
yesterday we heard from Khalid Al-Hussan that there are something like 57 IPOs in the pipeline. So, Abdullah from Riyadh Capital, if I can come to you and ask you, how does that diversification happen? Is it a natural, organic process in a country that's developing on all fronts, that's trying to diversify its economy? Is it something that needs to be, supported by capital? How does it work?
Thank you. I think first, I think what's guiding the whole changes in Saudi Arabia is the Vision 2030. And as a result of that, so many programs and initiatives have been actually implemented. Many of actually under the CMA and the Financial Sector Development Program, where they're opening up and the market and enhancing the regulations to sustain this growth. Lots of opportunities are being now offered to the international investors. As said by Ken, this is one of the fewest places now, given all the geopolitical changes and volatility globally. The Middle East, especially Saudi Arabia, a real economy that has been unlocking its own value for itself and for the world to explore and eventually to invest. So we see the changes driven by the vision and also regulatory enhancement following for that, and the recent inclusion of the Saudi equities and major indices have propelled the growth and the interest by not only by the regional or local, but also by the international. And the standards that we have right now, relatively speaking, in my opinion, this is, in terms of governance and disclosures for the listed companies, are actually meeting, if not actually exceeding, the best practices globally.
Abdullah from CMA, if I can ask you, many of the large companies have relatively small stakes listed. Would there be any effort to encourage them to perhaps list more?
Yeah, of course. It's today when we see the regulatory ecosystem, it is focusing on IPOs, and which is a market that is very much emerging. We are recently published for public consultation the FMO framework, which is a framework that enables large shareholders to float additional shares within a process that is governed and regulated. which is a catalyst for increase in free float. One more thing we are also doing, which is increasing the awareness within companies and shareholders about the benefit of increasing the free float. As Abdullah mentioned, the inclusion in indices brought value proposition to companies, wherein more free float means more higher weight in the indices and therefore attracting wider range of investors. And this part of value comes with awareness and education of companies and having some precedents as well.
Should we be expecting some of these follow-on offerings this year?
We had STC FMO 2 years ago. And since we had this practice in the market, we should regulate, because we are following always a concept of trying to enable by regulations.
Claire, that's one thing that we have seen. So while there's been huge demand and very successful IPOs, huge demand for them, secondary offerings perhaps maybe not as successful. Why?
We just haven't seen as many of them yet in the region. It is a really important development point for the market. Again, it comes back to the confidence point in terms of being able to see that these deals work, both for companies and issuers. Companies want to know what happens beyond the IPO. Is the market capable of sustaining my ability to raise capital, or indeed for shareholders to be able to monetize on an ongoing basis? But investors want to see more liquidity. They want to have greater involvement in terms of the markets. That's what we see in markets elsewhere around the world. A very significant part of the issuance in markets comes from secondary activity. So that is one of the key areas of development for this market. It's also an important area where international investors play a very important role, because having familiarity in terms of pricing risk, which is really what secondary transactions are about, familiarity with businesses, being able to price that risk, the involvement of international investors and the confidence that brings to domestic markets and domestic investors is going to be really important in the Saudi market as well. So we definitely think that it will come, that it is coming, but yes, it will be important to see more of that to continue the confidence that is already built in this market.
Exactly, and Richard, you have to wonder about liquidity, and do you have liquidity concerns, particularly if we do see some major secondary offerings, which it sounds like we're going to, and we have reported that there are potentially at least one large one in the works.
I don't think we have liquidity concerns per se. So first of all, kind of breaking down that question, the Saudi market, from a liquidity perspective, how much volume it turns over as a percentage of the addressable free float, is up there with developed markets. Then you've got the the ability for the market to absorb more stock, which I guess is your question in terms of both the domestic and the international market. The domestic investor base continues to be very vibrant in all the conversations we have with Abdullah and his counterparts around the kind of local investor base. That sentiment is strong. And then international investors, notwithstanding the progress they've made, are still underweight versus their benchmark. I think we published a piece of research this morning that says we could see the MENA region becoming 10% of MSCI EM. That would put it in parallel with Latin America as a block, and the kind of biggest block outside of Asia. Saudi is about 70% of that. If you then see what that would mean in terms of passive and active flows, something like $50 billion. Now, that's over a period of time, but one of the things that's going to increase the index weighting and increase liquidity is indeed further issuance, but be that IPOs, which we've seen so far, but to Claire's point, the follow-on offerings. And we'll see that, we think, in both fully marketed form per STC a couple of years ago, but also the other kind of mechanism in the developed market is what we call an accelerated book build offering, an overnight transaction where there isn't marketing. It tends to be a bit smaller, needs to be in an absorbable block, but that again is, I think, a muscle memory that the market is seeking to build, but hasn't yet built, but we're confident it can.
Well, and of course you need the whole infrastructure for that, and I'm curious, Ken, how do you make sure that there's research, that there's, all this other bits of infrastructure that investors are used to in other parts of the world?
Sure, and of course, research is important, particularly for international investors sat in London, New York, Boston, etc., so that they can get an independent picture and thorough analysis from analysts they know and trust in the marketplace. So at Citi, we cover approximately 60 stocks in the region. Most of them are Saudi stocks. We'd like to cover more. Obviously, there's a human resource element to covering more because it takes quite a lot of time and an effort to produce research. The easiest way to get banks like Citi and global banks to cover you clearly as an issuer is to involve us. It's somewhat self-serving, I suppose, but to involve us as a global coordinator in your transactions, and then effectively we will automatically pick up research coverage. So I'm sure you'll see more from all global banks because the demand from the buy side for research is extremely strong, but it just takes time.
Well, speaking of Citi research, and it was not planned, but Citi has said that if the kingdom could double the reform measures it implemented between 2016 and 2022, that could help grow GDP by an additional 1.1 percentage points. And it also looked at, relative to OECD averages, it's gone from sort of 40% to 35, 34%, which is an improvement of that much in terms of the gap between the standards OECD-wide and Saudi-wide. So there is reason to enact all these reforms, and by the way, that's government-wide, that's not just CMA. But I'm curious as to your top priority when it comes to reform in order to attract all of this capital that's out there just waiting to go somewhere. And we know that China is a little murky at the moment. We're not quite sure how China is going to turn out. Russia is uninvestable for many funds, and South Korea might be moving into a developed markets category. So there's a good opportunity to be had.
Well, it's a very important question, and if I try to link the role of the regulator to making sure that the market is attractive and growing and attracts more inflows from international investors, I want maybe to say one more fact that the capital market authorities' roles and responsibilities in the capital market law include market development in addition to investors' protection. And some may say that this is some kind of contradiction. And we don't see that contradiction because we are quite mindful that if the market is wider in investors' base, product base, issuers' base, it's not only good for growth, but also good for stability and prosperity. So therefore, we are trying to adopt the concept of enabling regulations instead of deregulations. And this is one of the things that you might find it different in the Saudi development endeavor. Whereas deregulation is could be a choice for different part of the world. And why we think it is very important? It is very important, one, we believe that international investors are into confidence before everything else, because confidence is the catalyst for international inflows. Second, of course, it's very important to solve for minimizing unknown risks, and therefore the visibility, not only for the regulators, but more importantly for investors, is there. And this is what international inflows are looking for.
Mm-hmm. Abdullah, let's talk a little bit, this is Abdullah from Riyadh Capital. Let's talk a little bit about debt markets, because as I said, both of you were at least somewhat involved in building out the yield curve, and as we know, the finance minister Jadan said yesterday that's going to be a priority. The debt markets need to be beefed up. What do you expect the credit markets to look like in, say, 5 years' time?
Let's put this in perspective at the beginning. The debt market globally is about $120 trillion in terms of size. About 25% of that is emerging markets. The size of the debt issuances that happened actually through Saudi Arabia, either external or domestic or local, were only about $360 billion. If you put that in perspective, within the emerging market alone is about 1.2%. And if you take it from a global, we're only about 30 basis points. Relatively speaking, if you look at the equity market, we are actually well represented, and the numbers are encouraging on that side. Nonetheless, we see a huge opportunity in the debt market. Both, as you mentioned, the yield curve is being built, as mentioned by His Excellency, the Minister of Finance yesterday, that enables the corporate and the semi-government and other entities to help them pricing, and also not only for the issuers, but also for the investors, locally and globally. And that, we saw a huge increase in the past few years when the yield actually started to build, and the past year was randomly, semi-randomly, I would say, priced. Now the rating is being introduced, local and international, adding those issuances, external and local. We see, of course, for the international investors, they also look at the USD. Nonetheless, we see also an opportunity for the local and domestic issuances like the Sukuk, where especially that's enhanced by the peg of the FX, the Rial to the USD, brings more comfort to the international investors. So we see a huge opportunity there. We expect more issuances from the corporate side. Probably at the time, this time, probably the cost of financing with the high interest rate probably not encouraging, especially for longer duration. For shorter duration, probably is something that we noticed being active. Once the interest rate stabilizes in the future, near future, we probably expect more issuances coming up.
And just sort of on a related note, there's a heavy state-owned banks presence. Would you want to see more private engagement? How would that happen? Is it something the kingdom wants? I guess that's to both of you in some ways.
You mean the
yeah, that a lot of the, sort of the credit that's extended now is by state-owned banks.
Oh yes, yeah. Now I think it comes also with the liquidity, because now the opportunity is to bring fundings from overseas to finance these projects and the growth that we're witnessing. And that's a huge opportunity also for the asset managers and for the issuers to list globally and also to be managed globally. So the banks are there, of course. They have been helping in financing, but additional venues and also the securitization of some of the debt that we see in some of the companies can also be another venue to establish other debt instruments.
And if I may add, today, the lending is dominated by bank lending compared to DCM. And globally, you will find the split 50-50 or 60-40. And the target is to change that and to be around 60 bank lending and 40 DCM. And we believe this is very important, not only for the issuers themselves, but also for the lenders themselves to benefit from liquid investments and lending. And one of the things that have changed the trajectory here is the zakat treatment, which we managed to, as a country, with the help of our friends and colleagues in Zadka, to enhance the zakat treatment for investors in Sukuk, which makes the investment fee, investment cost much lower than in the past. And this is going to help the companies and the investors to move from bank lending and direct lending to DCM. And one of the also signals of that trajectory is that banks themselves increased their issuances recently, and this is a very good example for their clients as well.
Mm-hmm. I want to ask about the composition of the market and how you think that's going to change over the next few years. But first of all, just in terms of competition, I mean, you three are sort of in the same game in a lot of ways, and you too, although you might have a different niche. Yes, you don't have to answer. How do you go about, I guess, selling your particular expertise as opposed to somebody else's here? How do you compete with each other?
Very effectively.
Who wants to take that? Well, to be fair, Claire does a slightly different job from Richard and myself.
More advisory.
She often decides which one of us.
Richard and I are constantly fighting.
I get to choose which bank is best in terms of which ones the issuer works with. But I think, look, I mean, the importance of the ecosystem here is that there is a lot of engagement from international banks and international advisors like ourselves, together working very happily with the domestic banks who have been established here for a very long time. So I think it is an important part of the ecosystem that we are all committed, we are all here, we are all present, we are wanting to compete with each other because we see this region and the companies within this region as being very important. So to me, it is although there is very active competition, that actually that's a sign of a very healthy market.
Exactly. Ken, about 85% right now of the market is local, so high net worth and so on. What do you see that changing to in 5 years, based on what you can see now?
Well, I think as has been said, and when we look at other jurisdictions around the world, particularly in this environment where, frankly, equity markets globally have had a bit of a lack of direction, the importance of a domestic investor base is really quite crucial when international investors are looking at allocating capital. So, the fact that you have both a strong institutional and retail investor base is terrific. I guess the flip of the side of the coin, that's meant that on a number of IPOs, international investors have had lower allocations than they would like. So typically, maybe 15, 20%, in some cases lower, have gone to international investors. And that is, of course, a problem for the largest mutual funds who are managing trillions, billions of dollars of AUM to get an allocation which is effectively too small for them because it doesn't move the needle, so what do they do with it, et cetera, et cetera. So I think one, as the market matures, we would like to see more stock going to the tier one quality long-only international investors around the globe, and ultimately that's a very healthy trend for the market, which we'd like to see continue.
Richard, can I ask you, why would a foreign issuer want to list on the Saudi exchange as opposed to maybe another regional exchange?
Look, I think and there's obviously been limited experience of that so far. I think probably the best case is the Americana IPO that listed, it's a UAE entity listed in Abu Dhabi and Riyadh in a dual, and a Tadawul on a dual basis, and has been highly successful. That's just kind of context. But to answer your question more directly, look, I think it's a vibrant capital market. It has a strong domestic investor base. It's well regulated. It's liquid. It has all of the, and it trades at an attractive multiple. And I think the market PE is around 21 times. That's the same as the market PE in the US, right? So it has all of the characteristics that are attractive as a putative issuer wanting to list their shares. Now, in order for that foreign company to list successfully here, and I think there's still some evolution from a kind of regulatory perspective to kind of facilitate that, I think there probably does need to be some form of regional nexus in terms of either from a shareholder or a business profile perspective. I think a kind of domestic UK issuer trying their luck and listing here to kind of trying to get a lower cost of capital, I think will be problematic. But I think global businesses that have Middle Eastern ambitions or regional shareholders, I can see that being a trend over time.
Or indeed, if they fit within the Vision 2030 key sectors as well, I think that's an important nexus. And we're seeing increasing sort of traction there as well. So there's definitely increasing relevance for a lot of, as you say, global businesses looking at the region. And as Ken said earlier as well, it's not as if there are many other markets in the world that are vibrant at the moment. So a lot of people are asking the question, how can we, or indeed can we be relevant in terms of a listing in Saudi? So it's really important.
But for companies which already have a foreign listing, the ability to have one ISIN, fungible stock across exchanges, is quite important. Otherwise, you can get split liquidity and liquidity trapped. So, we obviously have the ability to do fungible listings in GCC, Abu Dhabi, etc. But it would be great to see that expanded to a longer list of global exchanges. Again, all these things take time, and we're moving absolutely in the right direction.
And Abdullah, since you're based here as well, I mean you're all based here, but Riyadh capital, I should ask you the same.
Yeah, I think you mentioned earlier about the infrastructure that's available not only for the local, but also now to be offered to everybody internationally. The market making, which was introduced recently, which is important to provide the liquidity for certain stocks that are with higher float ratio. And we see that more interest in recent years, and also the inflow, as mentioned yesterday by His Excellency, the Chairman of the CMA, about the constant net inflow into the market, and driven by looking for growth and for opportunities, but also recent overweight of Saudi Arabia in some of the indices. That provide, I mean, in terms of the infrastructure, I think, and the auxiliary services that comes with it, is very conducive to create a very attractive market that brings confidence, high regulations and proper regulation, and also the flexibility of hearing from the market globally, and trying to make it a better market.
Well, we are out of time, but before we go, I want to give the last word to you, Abdullah bin Ghanem, if you don't mind. I know there's a lot of people thinking about this, but I am curious as to regulation of fintech, the blockchain, crypto. How are you thinking about this?
Well, today we are using fintech as a very important catalyst, and not only for capital raising, but also to institutionalize the market. The fintech lab that we opened and introduced allowed not only the conventional fintech, equity crowdfunding, debt crowdfunding, but also robo-advisory, funds distribution, and these are feeding into the institutionalization of the market. And of course, it is accommodating for all the trends, including the blockchain, for example. And this is one of the areas that are nationally taken to gradually adopt in the future.
Okay. I want to thank you all for your time. Very generous of you to go on a little bit longer. And thank you all for staying with us. And a round of applause, perhaps, for our panelists. Thank you.
Thank you.
Thank you, ladies and gentlemen, for this very informative and insightful panel. Now we have a focus panel that is tackling a subject, one that I personally have immense interest in, which is incorporating the human aspect in our lives and in our corporate lives. So I would like to welcome Dr. Mark Rittenberg, the founder and Chief Creative Officer of Berkeley Executive Coaching Institute, for a pretty interesting SCMF talk about, discovering your authentic leadership and the power of human connection. This panel will begin momentarily. So, Dr. Mark, please do make your way to the stage, and thank you very much.
there, sure. No, no.
Okay.
It's all yours.
Hello.
Hello. How are you?
Yes. Dr. Mark, how are you doing?
I'm doing very well. How are you?
I'm good, thank you. Can you tell us about, the subject that you want to talk about today?
The subject I want to talk about, I want to talk about people.
Yeah.
I want to talk about the human side of the workplace. It's been an amazing conference. I think Vision 2030 is amazing, but let's not leave the people behind, because in order to achieve this, we need loyalty, we need people to be empowered, we need independent thinkers, and we need them to feel that the people they're working for care about them, care about their future,
Yeah.
good coaches for them, and all that
And
kind
we
of
were
thing.
just having this conversation backstage, you and I.
Yes, we
so
were.
Tell me what you feel is the importance of discovering, authentic leadership through incorporating the human aspect, especially in a time like today.
Oh, well, if you're going to be building something as big as you're building, how are the people going to feel included? Because what I've found is that in all the studies we've done, I'm a professor at UC Berkeley in the Haas School of Business, and I have a lot of Saudi students, fabulous students. And they're telling me we want to be seen, we want to be heard, we want to be recognized, and we want to make a contribution. Not just the Saudi students, all new emerging business leaders want to be seen, they want to be heard, they might want to be recognized, and they want to make a contribution.
Right.
And when they feel sidelined or not listened to, or that they're just a number, they lose interest. They don't work as hard. And they start to look, wait, maybe I can work at this other company. Because people do not leave companies, ever. They leave managers. So what we have in California with the Silicon Valley, we have a wonderful street called El Camino Real. And I've interviewed hundreds and hundreds of bright students from Stanford, Berkeley, all over the world. And I said, why did you leave? Why did you leave the company? He said, oh, I haven't seen my manager in a year. It's all Zoom. My manager is absent without leave. There's no coaching. There's no mentoring. And I went to find somebody who would be a great teacher for me. So that's what it's all about. So what I want to talk about here, if I can, is as you're moving into Vision 2030, each person in this room and all the people that are leading work groups in these wonderful companies, and I've had a wonderful time here. It's a wonderful country, wonderful people. What you're building is amazing. They need to become people leaders, and they need to become leaders that develop their people. Because I can tell you, I'm a grandfather with 3 grandchildren.
You told me.
But the fact is that we're dealing with people in their early 20s, mid-20s, very young population, and they do not want to simply go to a job for the rest of their life and not grow and not develop as people.
Right.
So that's like very, very much it.
Right. How do you see the balance, as in your mind, in this era that we're living in right now? It's very fast-paced, very tech-driven. In your mind, what is the right balance, and how can corporations or just people in general, kind of achieve that adequate balance?
Oh, okay. So the adequate balance, first of all, there's a lot of work to be done, and that's great. But I'm asking leaders, what are your values? What are your values? What do you believe in? Do you believe in empathy? Do you believe in building trust? Do you build that? So it becomes a lifestyle. It becomes a lifestyle within the company. So it's not, oh, we're going to be good for a day, or we're going to have a great time for a day. So it's very, very much that in terms of if your values are empathy, honesty, humanity, building trust, caring about people, listening to people, that becomes your lifestyle.
Yeah.
That becomes your lifestyle. Can I tell a quick story?
Of course.
Okay, and I want to get a little closer to the audience, and you can come with me too if you want.
Sure.
Great. Okay. Good afternoon, everybody. How are we? Are we still awake? Okay, great. So, I'm here to, first of all, tell you what a wonderful conference this is, and what a wonderful, wonderful community you're building. But you need to bring the people skills of listening, people skills of coaching, all those things. And the good news, every single person here can change the movie. Change the movie from, a little bit of AI, a little bit of this, to be a real human being who develops their people. Be a coach who develops their people. So I'm an executive coach, professor at Berkeley, lots of Saudi students, beautiful students, brilliant. And they all tell me, yeah, we need the people skills. We don't have enough empowerment. We don't have enough independent thinking. We love our country. We want to build something really amazing. But there's not enough people leadership that's going on. So I worked with a gentleman at one of the national laboratories in America some years ago. His name was Jack. And a very nice guy, but nobody liked him. Nobody liked him because he wouldn't sign any purchase orders. He was just stingy with the money, wouldn't spend the money from the Pentagon. And we did a little study and found out 71% of the laboratory wished that he wasn't there. And so I said to him, you get really bad results. Oh, everybody gets bad results. We know all about that. Okay, so we did that. And I said, you know what? Let's stop coaching. You're not listening. You don't want to change. You think you're perfect. He says, no, Mark, don't leave me. Don't leave me. I said, why not? I'm wasting my time. I said, I can work with anybody. I don't want to work with a loser. You don't want to win the minds and the hearts of your people. That's all there is to it. He says, can I have one more chance? I said, I'll give you a chance. We're going to do a leadership academy and train emerging leaders, 400 emerging leaders in the entire lab. And I want you to do the opening night and tell a leadership story. He says, I don't have any stories. I said, at 68 years of age, you don't have one leadership story? He said, okay, well, I'll try to find one. So the night comes, we're going to start the Leadership Academy, November, I think it's 2011. And he gets up there and he says, I'd like to share a little bit of my story with everybody here. And it gets very quiet, 400 engineers all sitting there, Albuquerque, New Mexico. And he comes towards the audience just like this. And he says, my father died when I was 6. My father died when I was 6. My mother, after she finished her regular job, had to put on a maid's uniform and go out and clean the houses of the rich people in Miami Beach so my 5 brothers and myself would have food to eat on the weekends. My mother will be 96 2 weeks from Thursday. She remains my most beloved hero. What do you think happened to the engineers when he said, she remains my most beloved hero? Anyone have an idea? What do you think happened? What do you think happened, folks? Come on, this is how we teach at Berkeley. A little bit of participation. What do you think happened, Lily? Hey? They cheered, they cried, they laughed, and they rushed to the stage, and they said, Jack, we love you. Jack, you're a real human being. Jack, you're amazing. I looked at his face. The look of joy on his face was amazing. The next day we met for lunch. He was a major Air Force guy, high up the Air Force. He's always early for lunch. He's 30 minutes late. I'm waiting for him for lunch. 30 minutes he comes up. I said, where the hell were you? Where were you? He said, I'm sorry, Mark. I was signing purchase orders. You were what? You were signing purchase orders. Last night I realized I'd held the lab back. I've held everybody back. And I have been so frightened that we wouldn't have money. And last night, the love I felt in the room, the positive energy I felt in the room, it was amazing. And I'm going to be a different leader now. And I'm going to care about my people. I'm going to coach my people. I'm going to be the leader that everybody dreamt of. We did another study to see how people felt. 98%, 3 months later, loved their leader because he changed the movie. You with me? He changed the movie. He was no longer no, no, no. He became yes, yes, yes. And I care about you. And how's the family? So, just real quickly, there are 5 powers of leadership that he used. 5 powers. They are, and this is the secret. So you want to take this down, record me, write them down on your hand, whatever you want to do. The power of presence, the power of communication, the power of conviction, the power of intention, and the power of knowledge. Those 5. Power of presence, communication, conviction, intention, knowledge. So let's talk about the power of communication. The power of communication. He landed the message. My father died when I was 6. My mother had to go and do extra jobs as a maid. The audience was so emotional. The power of conviction. He loves his mother. She's going to be 96. And you felt the energy, the passion for his mother, the universal. So the power of conviction, he believed in his story. The power of intention. He knew to talk to the audience about a mother. Everybody has a mother. Everyone has a father. And so he read his audience perfectly. She'll be 96 in 2 weeks' time. She remains my most beloved hero. And then the power of knowledge. He told his leadership story. He told his leadership story. And the first one, the power of presence, the leader's teacher. He said, I have the right to be here. I have the right to be here. Power of presence, leader's teacher. Power of communication, land the message with compassion and empathy. Power of conviction, what are you passionate about? My family. What are you passionate about? Vision 2030. What do you care about? Tell your people what you care about. Don't be a robot, be somebody who really cares. Power of intention, this is what they need, and power of knowledge, what I know to be. So, those are the 5 powers, and I want to do a little bit of work with you now in the audience, just in the audience. Turn to your neighbor on your left or your right, or in back of you or in front of you, or all around you. And all I want you to do for a minute, I want you to do some relationship building. I want you just to share. What are the values? Look, these 2 are perfect here. Okay, what are the values that hold your family together? What are the values that your family lives, that hold your family together, that make your family strong, that make your family forever? Okay, take it away, just 60 seconds. Share, I want to hear a couple of these. What are the values my family lives by? Is it trust? Is it care? Is it loyalty? I don't know, but just turn to your neighbor. You have 60 seconds and talk. Go for it. Everyone, turn to your neighbor and just, what are your family values? Another 30 seconds. You're doing great. Relationship building. Okay, so that's the power of human connection. You just connected to another human being. A human just met a human. About my family values. We all have family, and I know in this country, family is number one. Family first. That's it. So I want to talk to my friend, first of all. Going to hear about her family values.
My family values are trust, respect, honesty, transparency, being there for each other, like rushing to help if anyone needs anything, and just being honestly caring and loving. I feel like love is the most important one.
Give her a big hand. That's great. Okay,
Thank you.
Wonderful. Okay. I just had back surgery, so that's why I'm using this cane, but I'm doing fine. I wasn't going to miss this conference. And I want to hear from Lily here, because it was her idea about family values. This is the one who came up with the question. Lily, turn to your audience.
Hello, thank you. Family value is very important for everyone. Love is very powerful.
Give her a hand. That's great.
Come on, you need to say.
You go. Well, we share similar values: love, sacrifice, empathy, caring, and these are values that are, I think, universal. But in Saudi Arabia, they're very, very cherished and very important. So, but thank you for the exercise.
Just say this again. One is
Love, sacrifice, caring, empathy.
Give him a hand. That's great. Yeah, sacrifice, caring. It's all about caring. And what people said to me in the crazy world we're in, love is the only medicine. Love is the only medicine. It's not about what it costs. Just let's get together, connect with each other. We have each other. It saved us during the pandemic, and it's saving us now. So as I wrap this up, I want you to take away three things. Three things. Number one, if you're the leader of the work group, what are your values? What are your values? Empathy, honesty, humanity, building trust. Don't be silent. This isn't the culture of silence. It's a culture of action. Saudi Arabia is on the move. It's an amazing country. I've been writing every night. What are the values? Live those values. Number two, the takeaway. Empower your people. Teach your people. Teach your people what the values are. What are the values you care about? What are their values? Look at this beautiful rendering of my family values. That kind of thing. What are the values? That's the second one. You live the values first. And secondly, teach your people, teach your children, teach your work group the values. Teach my grandchildren. Be nice to everybody. Be good to everybody. Be kind to everybody. They say, yes, Papa, yes, Papa. I said, yes, that's what you do. And the third one, create teams, work groups, where living the values is the norm. Not the special values day, not we're going to be good today, not that, 24/7. If the values are empathy, honesty, humanity, you live that 24/7. And you do your very good work around finance. And I promise you, these teams will stay together for a long time. You'll have loyalty. You'll have unity, and all the things that you always dreamed of. Nelson Mandela is my hero because he came out of prison 27 years, no hatred in his heart. No hatred in his heart. And he said a wonderful thing. I was there, Cape Town City Hall. He said, we're all teachers for each other. You're a teacher for me. I'm a teacher for you. That's what we did on Robben Island. It wasn't a prison, it was a university. Where are the teachers? Go look in the mirror. In this room here, you're all teachers for each other. Do you get that? Each of you has such knowledge. I have learned so much. I'm not a finance guy. I'm a leadership guy. But I've learned so much from all of you about the way the world's happening. Become a teacher for each other. And I want to just close with a poem that everybody thinks Mandela wrote. The internet says Nelson Mandela wrote this, and he spoke it at his inauguration on May 4th of 1994 as he took the reins of power of a free, democratic, non-racial South Africa. He's very involved in that country's freedom. And they said, Mr. President, did you write this poem? And did you speak it at your inauguration? He said, I did not write the poem, and I didn't speak it at my inauguration, but I wish I had done both. I wish I had done both. So I dedicate this to this wonderful community of wonderful human beings that I've met at this conference by Marianne Williamson. And what she said was, our deepest fear is not that we are inadequate. Our deepest fear is that we are powerful beyond measure. It is our light, not our darkness, that most frightens us. We ask ourselves, who am I to be brilliant, gorgeous, talented, fabulous? Listen to those words. Who am I to be brilliant, gorgeous, talented, fabulous? Who are you not to be? Your playing small doesn't serve the world. There's nothing enlightened about shrinking so other people won't feel insecure around you. We were all meant to shine as children do. We were all meant to shine as children do. And we were born to bring goodness to everyone. It's not just in some of us, it's actually in everyone. It's actually in everyone. And as you let your own light shine, you give other people permission to do the same. That's the leader. Let your own light shine, you give other people permission to do the same. And as we're liberated from our own fear, our presence automatically liberates others. Our presence, leadership power 1. Our communication, number 2. Our conviction, number 3. Our intention, number 4. And our knowledge. You're a wonderful audience. I am so honored to be part of your work towards Vision 2030, and I wish you all the best in the years to come. Thank you so much.
Thank you, Dr. Mark. Honestly, I have no more words to say after this fascinating speech, to be honest. Let's hear another round of applause for Dr. Mark. Thank you so much, really, truly. I really appreciate it. Ladies and gentlemen, I believe it is our lunch break right now, and we will reconvene at 1:40 right here. Thank you so much. Welcome back, ladies and gentlemen. We will now commence with the MOU signings. We are pleased to announce the signing of an agreement between the Ministry of Human Resources and Social Development and Saudi Exchange to launch the Social Responsibility Index. Thank you. We are pleased to announce another MOU between Saudi Exchange and ATRAM aimed at collaborating on educational programs to nurture artistic talent, joint investments in art-related projects, and partnering on public art installations that contribute to the cultural vibrancy of different cities in Saudi Arabia. Thank you. We are pleased to announce another signing of an MOU between Riyadh Capital and eFund. Thank you. We are pleased to announce another signing of an MOU between Muqasa and InstiMatch Global to launch the repo trading platform for the Saudi market. Thank you. Another MOU signing between Saudi Exchange and SALIC. Signing this MOU will foster exploring sustainability opportunities and joint initiatives, including educational programs, awareness campaigns, and investor outreach activities. And last but not least, we are pleased to announce the signing of an MOU between Saudi Exchange and Shatlat aimed at bolstering Tadawul's green initiative execution and planting of trees for each company listed and for every new member joining the capital market. Thank you, ladies and gentlemen. That wraps up our MOUs for today. We will now resume with our focus panels, and this one is titled A Self-Reflection on an IPO on the Saudi Exchange. Our speaker will be Dr. Mohammed Farouk, the Group CEO of Addis, who will be sharing insights and experiences on one of the largest and most recent IPOs on the Saudi Exchange, and it will be moderated by Mr. Ma'an Al-Namrawi, who is the Global Head of Commissioning for Alpine Unlimited. This panel will begin momentarily, and until then, gentlemen, you can please make your way to the stage. Thank you.
Good afternoon, all. I think it's quite challenging to have a session after the lunch. However, we will try to make it short and efficient as much as possible. If you allow me to introduce my guest today, Dr. Mohammed Farouk. He's the CEO for Addis Group. My name is Ma'an Nimrawi. I'm the Global Head of Commissioning for Alban Limited. To be honest, today we are not going to hear something about fintech companies. We are not going to hear about tech-driven or tech-savvy companies. Here we are going to talk about another story. This story I like in person because I'm an engineer in training. And I would like to hear about success stories for those companies who are providing such kind of hardcore engineering services. Addis Group is one of those companies who are providing such kind of services for oil and gas industry. So, Mr. Farouk, tell us about the story about Addis. What's unique in there? And what is your strategy in Saudi Arabia?
Thank you very much for the introduction. And I'm really happy to be here in Riyadh. Again, Addis is a drilling player. Today, Addis is the largest global offshore jackup player worldwide. Also, we do land drilling. We work for big national oil companies led by Saudi Aramco, Kuwait Oil Company, Qatar Energy, large international oil companies like Eni, Total, and others. We are today very proud having more than 8,000 plus employees. We are, our headquarters actually in Khobar, within Dammam in the eastern province of Saudi Arabia. We today really operate out of 8 countries. We operate in Saudi, Kuwait, Qatar, Egypt, North Africa, Tunisia, Algeria, and recently India and Indonesia. We have big operation. We are actually pre-qualified in most of the global world. Really, we have been growing significantly over the last 10 plus years by seeing the opportunity of oil and gas services, where I would say the energy train has been moving from west to east, creating some kind of vacuum. We have seen this vacuum coming, and we acted proactively early to work on consolidating the market and putting a lot of the offshore and onshore companies, either organically, inorganically, under the flag of Addis and under the Saudi flag. We are really happy because Saudi, as one of the largest producer of oil and gas worldwide, has deserved to have the largest player into that arena. And today we are very proud to say this player exists and leading this sector in a very proactive manner. We really have one of the highest standards into safety, operational excellence, which I think is one of the mandatories to work into that business. It's not about the financing, it's not about the equipment, but it's all about the operational excellence and safety. For sure, today, by operating into that area, we found the strategy, given that has been mentioned several times by His Excellency, the Minister of Energy, Prince Abdulaziz bin Salman, that Saudi will continue to drill until the last oil drop. So that gave us a good vision on the future, that we are here to last for a long time. It's not about tactical, as some of the other companies were actually getting out of business. And we are building this platform, which today has been proven to be very successful in terms of growing the business. So that's just a quick introduction and where we are heading, hopefully, in the future.
Interesting, interesting. Actually, navigating from private to public for organization is quite challenging. Quite challenging, quite demanding, and it might impact the way the business is modeling himself to deliver the value. So could you please just tell us about those challenges that you have faced? How do you facilitate those challenges? And what's the impact that you witnessed on Addis by moving through this IPO?
Great. I think the important part here is that we were a public company in London Stock Exchange between 2017 and 2021. Late 2020, we have been approached by the PIF to take the company private, and we agreed with the shareholder to do so. And at that point of time, we took the company private. We put a lot of resources to grow the company, again, organically and inorganically. At that point of time, just to give an idea, our backlog was close to $1 billion. And over the last 3 years, we have grown the company until our backlog has grown to $7 billion, almost sevenfold. And we really use this opportunity to grow the business, and which has reflected in terms of growing the top line, bottom line, the number of people, moving the headquarters. And this was an interesting journey of consolidation where we were 15 offshore assets. Today, we are 49 offshore assets, as I said, leading the global market. We also have today almost 37 onshore assets. And the journey was very interesting. And I remember the first time I met the Deputy Governor, Mr. Yazid Hamid, and I was very proud talking about business plan and talking about the business and how we will be a regional player. And his statement was very bold and bullish, say, we didn't invest in Addis to be the regional player. We invested in Addis to be the #1 global player. And this was very encouraging, give a lot of enthusiasm and give a lot of vision. And I have to say that really we have got access to the market here from a financing aspect. We have been encouraged to hire more people and localize the business. And really today we are very proud to say that all the revenue, which part of it in the past was going outside, being maybe managed through US and European company, kept in Kingdom. But more important, we have inflows coming from the region, namely from Qatar, from Kuwait, from other markets. This US dollar actually coming to and stay here in Kingdom, which is part of the vision of His Excellency the Royal Prince, where he said, we want to have our local player to be really strong enough and give them the access to a global market. And this is what really happened over time. And I have to say by maybe late 2022, we agreed, based on the size of the business, to take the company to Tadawul and work on that. We have done a good work with the regulator, CMA, who is really encouraging to build such capability and put this oil and gas hub led by companies like Addis to be here in Kingdom, encourage others. And we were very pleased with the exercise, with the regulator requirements. And I think we were able to raise $1.2 billion. Actually, just to say, we were covered more than 60 times with $72 billion, which I think is very encouraging. A lot of Western or European US flows coming. And I think we have done a great listing with a great success, with a great, I would say in terms of liquidity, in terms of market cap, in terms of the foreign versus local. And this has been recently showing a success by getting included into the MSI. So we are today included in the MSI as really the first regional driller to be in the MSI. We're very proud to be part of this, which I think will start early March, the trading from an MSI process.
So you feel the whole ecosystem has interactively contributed in seizing this opportunity and facilitating such kind, including the financing facilities, etc. The whole ecosystem has contributed effectively to this. Now, let's move to a very important questions, because currently everybody, including the investors, are questioning not only the financial statement of the companies, they are looking beyond to the impact that the company might have on the environmental as well as on the society, including the governance it adopts in order to make a sustained growth in future. Could you tell us in a brief, in less than 1 minute, how Addis have went through the ESG, let's say, journey as part of their growth and sustained growth?
Sure. For sure, ESG is part and parcel of our day-to-day. It's really part of the 2030 vision. From an environmental point of view, we are very keen to reduce emissions significantly by 2030 and the carbon consumption. On really the part of governance, we have been practicing the governance since we left London. We didn't leave it. Yeah. We have the committees from the remuneration committees, the internal audit committees, the executive committees, and from governance, we have a good, actually 3 independent board members has been there, and we are continue doing that. From social responsibility, we are part of the SADA program, which is Saudi Arabian Drilling Academy established by Aramco, where we are committed to train and develop 200 graduates with time and invest more than $4-5 million per annum to do so. Part of it is taking or establishing and be part of a sponsor for the largest children hospital in the region, which I think is also part of our social responsibility. So we are working hard to achieve this and fulfill this.
And I think out of the 8,000 employees you have, 5,000 are
sitting in Kingdom. More than 70% of that are Saudi really laborers between girls and boys. We are very proud having this team part of our organization.
Interesting. Time flies. It was a very interesting discussion with you. I thank you very much for this discussion. Thank you all for your attendance and for listening. Please join me to have a cheers for Dr. Farouk for this interesting session.
Thank you. Thank you. Thank you very much. Thank you very much. Appreciate it. Thank you.
All right, ladies and gentlemen, next up is a presentation titled Modern Day Education Advantage Saudi Arabia, where CEO of the National Company for Learning and Education, Mr. Mohammed Al-Khudair, will be sharing his valuable insights. So, Mr. Mohammed, please make your way to the stage. Thank you.
بسم الله الرحمن الرحيم والصلاة والسلام على رسول الله نبينا محمد وعلى آله وصحبه أجمعين. السلام عليكم ورحمة الله وبركاته. Good afternoon, ladies and gentlemen. I am Mohammed Al-Khudair, CEO of NCLE, and I'm delighted today to share a few thoughts on modern day education advantage Saudi Arabia. So in order for us to comprehend the modern day education, let's delve into all-day education. And for that, I would like to share a very short story. A 9-year-old boy in 1934 in Al-Qasim, Saudi Arabia, noticed an optimal environment for a distinguished passing guest. There was a very important guest passing by the village, and he saw the village families are preparing a very nice environment. So he asked his father, who is this guest? His father said, it's the judge who is passing by to spend a few days. And judges back in the days used to spend a few days in multiple villages to perform their official duty. So he decided from that day to become a judge because he wanted the status. So he asked his father about the pathway to become a judge. His father said, it's education. Learning is what made the judge the way and get him to the status he is today. So he went to school in Katatib, but he sought more. It was a good start, but he wanted more. Until one day, during play, he saw a child, or he saw a young man wearing socks, and he was inspired by that socks. It was the first time ever to witness a sock. So he asked his boy, what are you wearing? He said, it's socks. Where did you get it from? He said, from Aramco. It's supposed to protect your feet. So he decided to join Aramco. He joined Aramco as a laborer, and his determination led him to become a student in Aramco schools until he became a teacher in Aramco, English teacher. This is the story of Sheikh Mohammed Ibrahim Al-Khadir, NCLE founder. After a few jobs in the government, he opened a Terbiya Namudajiya school, NCLE flagship school, in 1958. The school was the first school ever to teach females formally in Riyadh. From early and modest beginnings in Malaz in Riyadh, NCLE went public in November 2018 and become one of the fastest growing education companies in the region. Mohammed Al-Khadir passed away last May at the age of 99, but his legacy remained with us, and his value are the values that we work by in NCLE. So when we look at the challenges back in these days, before 1960s, in education in Saudi Arabia, we had lack of proper infrastructure, slow technological advancement, high illiteracy rates, high illiteracy rates, no formal female education. But Saudi Arabia has succeeded in them all. Today we have over 32,000 well-equipped schools. In technology, we outperformed OECD countries in COVID readiness. We enjoy 100% enrollment rates. And in female education, not only 50% of the 6 million students are females, but Saudi Arabia is one of the fastest countries in the world in female participation in the workforce. So what are the challenges of the modern day education? The government spending on education as a percentage of the total budget is very high compared to regional and global benchmarks. As so the public expenditure on education as a percentage of the GDP. Yet, student achievement is lagging. So the Ministry of Education highlighted 5 major challenges that we face today in the education system. 1, underperforming K through 12. 2, inflexible pathways. Significant gaps in access and equity, only 21 to 22% enrollments in kindergarten. 4, limited efficiency. For every $1,000 spent in the education system, we get 28 PISA points, the PISA exam points, while average OECD, for the same amount, $1,000 spent, 50 PISA points is achieved. 5, there is large room for improvement in extracurricular activities. So key questions to be explored. 1, what sets education apart in Saudi Arabia in the new era? 2nd, how would the private sector contribute to revamping Saudi education? A new era, Vision 2030, and the Human Capability Development Program. The Human Capability Development Program, which was launched a couple of years ago, aims to achieve a status in the Saudi student to be a globally competitive citizen through three major strategic pillars. Develop a resilient and strong educational base, prepare for future local and global labor market, provide lifelong learning opportunities. And I would encourage each one of you to research about the HCDP and read about it, to understand more about the impact on the HCDP on education. So HCDP is one of only 2 out of 10 vision realization programs chaired by His Royal Highness Crown Prince Mohammed bin Salman, which signifies the importance of education in achieving Vision 2030. Driving change, the role of private sector in Saudi education. Do you recall this chart I just showed earlier, which highlights the 4th grade math exam performance? Here is the same chart when we analyze the private schools individually or separately. Private schools outperform not only KSA in general, but also MENA. Now, Vision 2030 sets a target to reach 25% private school penetration rate. This year, it's only 16.5%. With the population growth, we anticipate 1.5 million new students to join the system by 2030, from 2022 to 2030. So when we combine the vision target of private school penetration and the population growth, we expect the market size will double by 2030 in terms of the number of students and the number of private schools. Today, however, the penetration rate of private school is still low compared to regional and global benchmark, which means the status quo will not get us there, and there must be innovative solutions. The Ministry of Education sets a strategy to foster private sector involvement in delivering services within the K-12 sector. This can lead to multiple solutions and multiple options in order to increase the private school participation to achieve the ultimate goal of reaching efficiency, decrease the cost, and improve outcome, such as contract school, voucher programs, and subsidies. Educational PPPs could take us to strategic gains in the national ecosystem. Lower government expenditure, larger talent pool to recruit from in terms of teachers, greater innovation as more focus on outputs and outcomes, expedited support for student needs and teacher training, accelerate implementation of the HCDP targets, and enhanced accountability over learning outcome. Thank you very much, and I wish you all success going forward. Thank you.
Thank you, Mr. Muhammad. Is it the time for active assets management in KSA? That is the title of our next panel, and it will be featuring Musharaka Capital CEO and Managing Director, Mr. Ibrahim Al-Assaf, Alinma Investments Chief Executive Officer and Managing Director, Mr. Mazen Baghdadi, GIB Capital's CEO, Mr. Usama Shakir, and MSCI's Managing Director and Global Head of Solutions Research, Mr. Raman Subramanian. Please help me welcome them to the stage.
Thank you. So, good afternoon. Welcome, Your Royal Highness, ladies and gentlemen. My name is Sally Ann Taylor from Bloomberg, and it's my absolute pleasure to moderate this panel this afternoon. And we've heard that the development of the asset management sector is a key pillar to realize the Kingdom's vision of 2020-30, especially for the ambitions of the giga and mega projects. And financing requirements, and hence investment requirements, will continue to grow. Alongside this agenda, the GCC asset management market is projected to grow to nearly $500 billion by 2026. And yesterday, the CEO of the Tadawul Group holding company, Khalid Al-Hussan, told Bloomberg TV that active investment on the exchange has doubled since last year, but is still massively outweighed by passive. And so with this in mind, we're going to ask whether this is the time to focus on active investment. So Ibrahim, I'd like to come to you first. You've some thoughts on how to encourage, through diversification, active asset management in the Kingdom. Can you expand on this?
Of course. First of all, I would like to thank Tadawul for the invitation and for carrying out this huge event. Job well done for Tadawul. Let me tell you a short story when we talk about diversification. About 15 years ago, the available investment products, or the most familiar investment products in the Saudi market, asset managers used to produce, is mainly between equity and real estate. I believe the diversification has to do with two major factors, which is the local economy status and the maturity of the financial markets. If we take the economy status, Saudi Arabia has recently diversified its economy away from the reliance of oil, which has created a lot of opportunities. The non-oil sector has been leaping beyond expectations, which allowed asset managers to basically develop products that has relation to different sectors. Moving to tourism, technology, infrastructure. All of these has created a very raw area where asset managers can bring about very creative products that has relation to the preference of the clients. That is the impact of the change in the economy status. The maturity of the financial market, and I believe this is the most important element for the market or the asset manager's diversification ability. Recently, the financial market has produced new products and new regulations. We've seen the derivatives produced in 2020. ETFs is becoming popular in the Saudi market. It's not developing as we want it to be. However, it is a first step. When we look at the US ETFs, in 2003, it was around 200 plus ETFs. Now you're talking about more than 3,000 ETFs. So This gives us some assurance that the Saudi market has taken the first step towards developing this particular product. Again, where does the demand come? Usually developing new products has relationship to the client demand. Client demand comes with wealth, and wealth is connected to the status of the economy. طبعاً, producing more products has also to do with the awareness of the clients. Today, the only reason why some products are not very popular is because of the client awareness. Something that they're not familiar with, something that they don't relate to, for example, compared to equities, real estate, and private equities. This will probably reduce the pace of the development of these products. However, I believe the Capital Market Authority, the asset managers, are working heavily on educating the clients, educating the asset managers themselves, and trying to develop the investment ecosystem in general. I personally I'm very optimistic on how things are going. I believe in probably 10 years' time, the Saudi market will be among the first 3 markets worldwide, provided the uprising of the educational level and the release of new product and the reform of the financial market in general.
That's very interesting, and I think yesterday the question was posed in one of the panels by His Excellency as to whether regulation was moving fast enough. Did you want to come in there, Mazen? But no, I think you're right, and in fact, when I was talking to Raman earlier before this panel, he said he's been coming here for a number of years and noticed more and more local talent within the financial community, which is really encouraging. And I think in terms of the derivatives, we'll come back to that later, because I think that sounds like it's a start, but it's been a slow start perhaps in terms of liquidity. But perhaps, Mazen, maybe we could take it a step back for a second and say, this panel is about active investment management. Why do we need active investment management, do you think, or do we in fact need it?
Thank you very much for having me today. I believe both active and passive management are valid investment approaches. However, with the recent and dynamic and changes in the global economies, the active management can spot some opportunities, and we see there are a lot of advantages for the active management over the passive management, especially at this point of time. I will mention, for example, first the freedom in asset allocation for any fund manager in the active management when they have belief in some stocks or certain sectors, and the conviction is high about these stories, so they can overweight, and vice versa, they can go underweight sectors that they don't like or they don't see a lot of potential in the upcoming year. Unlike the passive, where they are mimicking the benchmark, and this will lead to the second advantage, which is the performance or generating alpha throughout the years and creating value added as a performance for the clients, for the funds, and create the track record for these active managers. Unlike the passive mandates, where we can see in some years at the end of the year it's slightly underperformed the benchmark because of the applied fees, such as management fees and other fees. Third advantage also, I would say, the risk management, where in some strategies they have the stop loss strategy in some mandates in the active management. Fourth advantage would be also the short selling or some hedging could be applied in some strategies. Also the fifth advantage, I would say, which is very important, is the tailored strategy, where some fund manager can apply some themes like ESG or Sharia plain, or in some cases we have witnessed in even our local market, the sectorial funds, where some investment companies create some vehicle and funds for some sectorial funds. And this could be very helpful for the portfolio managers who manage multi-assets mandate in terms of asset allocation, and if they prefer some sectors and they have some high conviction about these sectors, so they can go and overweight these sectorial funds.
No, that's great. And so we agree that active investment management is needed alongside passive, and we'll get to Rahman on that point. But what do you think the asset managers need to be successful? I mean, education was one thing that Ibrahim brought out. What else do you think?
I believe there are some very important elements. First of all, I would say the clear investment objective and guidelines between the portfolio manager and between the client, where the fund manager can prepare a roadmap and apply the discipline in these mandates. In the fund side, we see the T&C and terms and conditions could be a very good example for the clear investment objectives. Second is I believe is the strong research team, where the buy-side research team, where they can really get advantage from mispricing in some cases in an efficient market, and we can see a lot of value. Being very active in visiting companies for the public equities. I would say, for example, we have seen this in our markets, the development in terms of earnings call, where the listed companies do earnings call after the earnings announcement, where the financial analyst and the research can ask their questions and share their forecast with the company. And this has very big, amazing development in our markets last 3-4 years. I would also say in the research, the accuracy of the forecast for this research, and how accurate and how it's close to the actual earnings when it's announced. Also, I would say the market intelligence is very important from buy-side research perspective. Third element, I believe, is the portfolio management and their skill through the expertise, some certificates like the CFAs. I think it's essential for the portfolio managers. Also, the great track record for the portfolio manager. I believe, from my point of view, also witnessing different cycles, this helps the portfolio managers in the volatile market to take the right decision, actually. Also, I would say the investment committee role, which is very important here. Some institutions, when they want to open investment with some houses, they go and visit and see and examine actually how is this investment committee being taken, what's the voting rights in these committees, is it a call of 2 portfolio managers, or it's a committee, and these things. Also, the wider investment universe, where the diversification of portfolio managers can do various asset classes, or even different geographical areas.
That's very interesting, because I think transparency is key, and information, and we'll come on perhaps later to ESG. But one of the global issues, and the UK is trying to tackle it, the EU is trying to tackle it, and elsewhere in the world, they've all been trying to tackle it. Doesn't matter which exchange you talk to and what size, is getting that research and that transparency to information. So if you're getting it from the start and you've got a good coverage, that's going to set the standard that international investors are looking for. So I think that sounds really positive. Osama, we talked about active and passive and the need for both. But is there a difference when you're looking at long-term and short-term investment? Because obviously you've got some very aggressive targets here in the kingdom for the 2030 vision. Can you tell us a little bit about your thoughts on that?
Certainly. First of all, thank you and for having me here, and thanks to Tadawul for organizing such a wonderful forum. It's truly amazing. I mean, I'll go back, just briefly to what my colleague Ibrahim said about the, basically, especially the foreign investors being passive rather than active. We have to, and what is required, we have to allow time. Just for your information, the Capital Market Authority was established back in 2005. And what has been done since then to the whole ecosystem is quite, dramatic. It's truly, truly, exceptional. We have surpassed, many jurisdictions that have been in existence and way, way ahead of us. So I think there is progress on, not on a monthly basis, but rather on a daily basis to further develop the ecosystem. And you have to allow time. Now, what you're talking about, what you're referring to as far as foreign investors are concerned, coming through passive strategies rather than active strategies, these are the must-do investments, being part of the global benchmark, so they have no choice but investing in the Saudi equity market. What is going to happen next is that what we're seeing it at the level of the country as a whole, Saudi Arabia is being discovered and explored by everybody. And this is why, the amount, I'm Saudi, born, raised, lived all my life here in Saudi, been abroad, traveled the world, and did study abroad as well. So I have very high expectations. What we are seeing now do, by all means, surpass all my dreams, truly. I have always been, accused of being an optimist, very optimist, even by international investors, because with my previous employer, I was there for 16, 17 years, and I did get to meet a lot of international investors. But even despite their accusations of me being a very optimist, what is happening is multiples of what I was hoping for. So I think we are not definitely, I know for sure that we are in the right track, but it will take time. So now, once they have explored the economy, what we're seeing, for example, over the past 12 months, you can see the activity picking up just over the past 12 months, let alone what's happening over the past 5 years or so. So I think the real start is probably 2023. This is the real start. Prior to that, we were laying the foundation to start, the mobilization or the execution. So this is the real start. So it will come because now Saudi Arabia is on the map. Absolutely, you cannot. I've heard this from, international, well-renowned international investors that you cannot ignore Saudi Arabia. So what's going to happen is that people will come, will understand the country. There is a stereotype that has been surrounding the country for quite a long period of time. And what we want and what the country has done is inviting and encouraging people to come themselves and see for their own eyes, rather than relying on a media. It could be against or for. You come and judge for your own self. And this is happening quite frequently now. So, and not only just tourists, but also you're talking about investors and businessmen. They're coming and they want to do business and they like what they see. So these are major, major changes that we are going through. And with that, we are going to see in the years ahead of us, we're going to see movement, starting in passive, but shifting into active, that people or investors will elect to invest in the Saudi market because of the growth potential that is, presented to them. I'm not older, I'm not young at all. I don't, and I have read about being in the investment industry. I had to read about economics and markets all over the world. I have not heard or seen, during my lifetime, such a change that is taking place with this magnitude, with this speed, anywhere else in the world. You cannot. Basically, I dare anybody to name a country that have gone through such a huge restructuring on all fronts, all fronts. People, Saudis would know, there were things that we never thought it would change. Never. It changed overnight, very smoothly. So basically, definitely, this is a waking giant, by all means. We've got things that no one else on earth has. We have the holy sites. That is the #1 target for the largest and most growing or fastest growing population in the world. So if you just get a fraction of that population just coming once to visit the holy sites, that is huge. So, and we have seen just one basically example, 2023 in comparison to 2022. There was a huge jump in the number of Umrah visitors, huge. I mean, even beyond the targets are set by the government. Now, the targets are constantly being lifted, constantly.
I understand that. Sorry to interrupt, because I heard that the licenses have been sort of doubling year on year that allow people, and you could just keep on going, as you say.
And so all I say is that we are moving in the right direction. You have to allow time. People will discover Saudi. They will elect to come here.
Yeah, no, and I can echo that as a first-time visitor to Saudi, and I will go back to the UK and be telling everyone I meet they have to come and see it for themselves, because it is so fast-moving. It is unbelievable, I think, from what I've gathered. And Ibrahim and I were talking about diversification, and it's not just the diversification within the financial services and tourism and infrastructure, but the wealth of geographies that you have, which I hadn't, in my naive outlook, had not considered beforehand, but I digress.
And add to that, human resources.
Absolutely.
No, absolutely.
Absolutely.
That is a big differentiator in the whole of the region.
Yeah, no, definitely. And before we move on to Raman, I'm conscious of time, but just going back to this diversification and the single stock equities that were launched recently, the liquidity is still needing to be built up. Ibrahim talked a little bit about education and culture. Is there anything that you see that could be done to encourage that further? That's for you, Osama.
Back to me?
Sorry. Yes.
Okay. So in terms, I think, again, I mean, you're talking about education, and I think, I mean, I have, again, worked with an international organization for almost 17 years. I was part of EMEA, and I dealt with, I mean, many people there. I mean, the operation that we had here in Saudi was 90% Saudis, 90%, I mean, homegrown and locally resourced Saudis. It was, I mean, basically by far the most profitable setup out of many, many jurisdictions, including main European countries and the US at the time.
Yeah.
So now we do have what we have had. Basically, I mean, the best people that I have dealt with are Saudis, female and male. So that's why I said human resources.
Yeah.
Currently, and luckily, and I mean, we're very fortunate, the quality even of the youngsters, the younger generation, is even better.
Yeah. Great.
So that, I mean, with that, you cannot go wrong.
No, that's very encouraging to hear. And Raman, sorry to leave you last, but definitely not least. So emerging markets have been a distinct investment class for a number of years, but we've seen sort of recent performance disappointments and geopolitical events that have meant that investors have lacked exposure to these markets. I mean, is the Saudi market and the asset management industry ready to capitalize on this trend? Do you think, you know, are they going to make the most? Will there be higher allocation to the region, do you think? And if so, how will that go about?
Okay. Thank you, Sally. And thank you, Tadawul, for inviting MSCI and the rest of the team here. So before answering that question, maybe I can give you some numbers which are very interesting. MSCI included Saudi in our global benchmark in 2019. The weight of Saudi Arabia was close to about 1.5, 1.6 percentage point. Today, you're talking about close to 5 percentage point in the benchmark. That's kind of close to threefold increase. That itself shows the testament of, you know, opening of the market, opening of the society, and the opportunity which is coming in. Now, but if you look at from a benchmark construction, going back to what Osama was saying, the benchmark is still very top-heavy. The top 10 stocks take about 60% of the weight of the benchmark. It's about 120 stocks. If 10 stocks takes about 60% of the weight, then it's very difficult for an active manager to actually beat the benchmark. You have to either bet against them or take a view on them. So, but what we are seeing is that slowly as newer IPOs are coming in, opportunities will be created. And that happens with every market. We have seen that every market, when they open up, whether it's, think about China A securities, more recently, we're talking about the UAE opened up and then Saudi opened up. Always the market opens with a smaller number of securities, and international investors will come into the market trying to get the benefit of exposure. They will go for beta exposures, and they will try to hug the benchmark. But the challenge they will see is that you're getting into a market not for benchmark return. You want alpha return on the top of the benchmark. And that's why the local active managers have a large role to play. One issue with the local active managers is that they are challenged by the retail mind setup of the people who are investing in their fund. And these retail managers or retail audience will always look for kind of not a long-term view, more of a short-term view. So they're trying to look for performance chasing. Whereas the institutional investors who are coming, they are coming for long-term view. So there's a disconnect between what the retail wants versus what the institution wants. And that's why education of the local market becomes very important. As the local audience or local retail investors become more educated, we have seen across the world, they will go for a more long-term view on any allocation, whether it's passive or active. And that education comes, it is started in the region, the regulators are educating, and that's why some of the ETFs are getting launched. It's a good way of getting exposure to various segments of the market. But ultimately, I believe both active and passive are symbiotic. One cannot exist in another because you require price discovery to happen, which active managers give. And then you want a long-term investor, then you have to take a passive view in the market.
Thank you for that. And in the last 3 minutes, I'm going to come to you, Rowan, because this was your question, but feel free to chip in, gentlemen. Digital transformation, we're talking about AI, everybody's talking about AI. I think we heard yesterday that the only topic at Davos was Saudi Arabia. I challenge that. I think it was Saudi Arabia and AI. But they are challenges, but they're also opportunities for investors. But how do you see the role of ESG and climate factors in alpha generation in the kingdom now?
I think you'll be surprised to know that this whole region was already ESG in one shape or form. And if you look at Sharia-based investing, is the first stepping stone. It's the values-based investing which people talk about in the ESG space. So you can further enhance that by taking a little bit more view on the ESG factors. So I think this region is completely ripe for that thing. In the space of climate, I think climate opportunities is where the focus has been. And we require energy security. So it's kind of not, people can't say that I don't want to be in energy stock because we require that kind of energy security. That's what we have seen in the past. But as we are seeing, Saudi and other markets in the region are focused on energy transition, which has been a big focus after the COP28. So you will see more companies coming in. There was one IPO recently which was done, and many more to come which will support the market.
Excellent. Anyone else want to add anything?
Yeah, maybe
yes,
I will add one point is regarding the knowledge and educating the retail sector and retail clients in the funds about the longer term horizon rather than the short term. I think the best ways to educate the retail is through showing the performance, past track record for these active managers, and we have witnessed that now in this field for the last 23 years, and they have witnessed big improvement for even the retail perspective, looking into the market, what's the long-term view for these investment, showing them the track record of these funds and the fund managers, and we have seen big even improvement in that.
Definitely, and linking it back to the increased GDP versus oil and non-oil. It's a fascinating topic, and we have run out of time. We could talk for ages on it, but thank you very much to all of my panelists, and thank you, audience, for listening. Thank you.
Thank you. Thank you.
Thank you, ladies and gentlemen. This next panel is one of high interest, and it will navigate through the current profitable sectors in the insurance market and the future growth drivers and the potential growth of insurance market segments. Our speakers are going to be Taunia's Chief Executive Officer of Health and Life, Engineer Mohammed Al Saeed, and Future Care's CMO, Chief Medical Officer, Dr. Nizar Bahabri. Gentlemen, please make your way to the stage.
I'm waiting for a signal to start, or shall we? Shall we? All right. Bismillah ar-Rahman ar-Rahim. Ladies and gentlemen, welcome to our session on the industry spotlight on insurance in Saudi Arabia, challenges and opportunities. It's an honor today to be with our esteemed guests, Mr. Mohammed Al Saeed from Tadawul Insurance Company and Dr. Nizar Bahabri, a infectious disease physician, a social media influencer, and a member of the Jeddah Chamber of Commerce Healthcare Council. My name is Samer Abu Ghazala. I'm the Chief Operating Officer of King's College Hospital in Jeddah, as well as the chairman or the head of the Jeddah Chamber of Commerce Healthcare Council. A lot of issues come to mind when we discuss insurance in Saudi Arabia. What comes to mind from the healthcare sector is that the industry started in 2010 with 3 million insured individuals of 8 billion riyal value, growing in 2030 to 21 million insured beneficiary with 60 billion riyal value. The industry is growing in a very rapid manner. Question to Dr. Al Saeed, can you share some insights on the profitable sectors of insurance in Saudi Arabia? And then we'll move on with other questions as we go forward. Please.
Sure, Samer. First, I would like to thank the Saudi capital market for the very nice organization and for the opportunity to discuss this important topic. طبعا, in terms of the sectors that are growing, in general, insurance is in the infantry stage. So it is growing. It has been growing very rapidly in the past few years. And we think this momentum and rate will continue for the next few years. And it's across all sectors of insurance, whether it's in the health insurance, which is the biggest part of the insurance sector, whether it's in the motor insurance, whether it's in the general insurance, and also our new baby in Tadawul, the life insurance, which we think it will boom. Globally, life insurance is the largest part of insurance. Where here in our region, it is still in the really baby stages, and we think it will grow very rapidly. I think what's more important than which sector will grow is the how. The journey that we have gone through since the inception of insurance and the regulatory insurance in Saudi Arabia is how it has evolved. I think the future where it will be relying more on digital, more on automation, more on enhancing the overall experience of the member throughout his journey. When we talk about mobility, it starts from buying the car. So we are at Tadawul starting the journey with how to buy a car or sell a car. if and la somehow there is an accident, how the journey takes place from end to end. And the transition is happening from reactive to proactive. We don't wait for the patient to get sick. We don't wait for the member to get into a car accident. We deal with the member or with the patient proactively. Two big initiatives Taawuniya was a pioneer in is the drive application in the mobility, where we look at the behavior of the driver, ensuring it has certain criteria in terms of braking, cornering, speeding, using the mobile, etc. And we reward rather than punish. So he gets weekly points for his good behavior, and he converts this behavior into points that he can convert into rewards in different areas. Similarly, in the health sector, we have Vitality, where we reward being proactively taking care of one's health in terms of being more active, smoking cessation, sleeping habits, dietary habits, and you get rewards on weekly basis, and you convert them into tangible benefits.
Wonderful. And I'll move to Dr. Nizar, and I'll pick on the healthcare sector specifically, and then we'll come back to you, Mr. Saeed, to speak more about the profitable sectors in the insurance industry. Dr. Nizar, preventative medicine, curative medicine, and then rehabilitative medicine and home health care, etc. Where does the market in Saudi Arabia stand now? Are we providing value for healthcare? Are we providing quality, safety, experience for patients? Are we reducing costs? Or do we still have a way to go to achieve these goals?
I think one of the most important things is we have to understand our situation right now. Unfortunately, I believe our cost is high because we are now on only a stage that we treat the sick. We only wait for the patient to become sick. Everyone in this hall who is attending now, if you ask him, when was the last time you went for a checkup? When do you take your father for a regular checkup? How did you have any kind of preventative program for you not to get sick? Did you ever, we all have genes, and then our genes will define our health in the future. So did you see what is your family is having as a disease, and then you need to prevent? The cost is huge because we deal with a lot of sick people, a lot. And then after we stabilize them, the insurance will ask, everyone will want to discharge the patient. And then if he is discharged, he doesn't have a very good follow-up at home. And then he doesn't become better. There is no good rehab. If you send the patient for every single day, you are in a hospital bed. If you are above 50, you need 4 days to go back to your good strength. What if the insurance give more support for the patient to have full physiotherapy after discharge, so he does not have worsening pneumonia and he come back to the hospital? Our only way to decrease cost is to, exactly as Mr. Saeed said, is we have to take care of prevention, and after discharging with good care at home, we have to look at every house, what kind of disease is there, and then we have to prevent it. If we want to give very good value and to extend life expectancy, also to decrease cost.
Wonderful. I think Saudi Arabia is moving towards value in healthcare. There's a center for value in healthcare in Riyadh that focuses on improving safety, quality, and experience while reducing costs, because the costs of healthcare across the globe are rising in a very huge way. Lifestyle diseases in Saudi Arabia are increasing, and these are cardiovascular disease, diabetes, cancer, and other diseases that are becoming very rampant in every house in Saudi Arabia due to the lifestyle that we live. Back to Mr. Saeed, profitable sectors in the healthcare and thus in the insurance industry. Is it the healthcare vertical? Is it the automobile vertical? Is it life insurance? the conference is focusing on the the financial sector, where do investors go?
See, the focus is in value. And value has three aspects: the experience of the patient or the member, the cost, and the outcomes. If we talk about, let's take health as an example, with the presence of Dr. Nazar to complement it from medical perspective. The concept that we are following is based on the population health management. And I will try to visualize it for the audience because it's a simple concept, and its beauty, it's in its simplicity. It is based on a pyramid. The base of the pyramid has a big number of people in terms of population. However, the cost is low. Yes. So what you want to do with these people, you want them to remain healthy. You want to encourage with them the habits that will maintain them into this portion. This is the best area where the population is placed. How do you do this? With taking care of their habits in terms of diet, in terms of exercise, in terms of smoking cessation, in terms of mental health. And the best approach is to do it proactively, encourage them with rewards rather than penalizing them with higher premiums. Why you want to do this? Because you want to prevent them from going to the second part of the pyramid. What's the second part of the pyramid? You can have uncontrolled patients or controlled patients when they get into chronic diseases. Someone like me, I will use myself as an example, in the mid-40s, parents with family history of diabetes and heart diseases. I need to take care, as Dr. Nizar mentioned, do my checkup, make sure that I'm not going into the borderline high. If I am there, I need to do extra effort. If I fall into a chronic disease, then I want to take care of my medications. I want to get into a chronic disease management program to ensure I take my refill and remain under control. Why I want to do this? To prevent myself from going from the top of the pyramid. Yes. Small population, big cost. What will happen there? Many visits to emergency, many admissions, many readmissions. What do we need to do to, again, maximize value? Do home health care, reduce the utilization on services at the hospitals as much as possible, and try to reduce the admission and readmission rates for this portion of the population.
Home health care, Dr. Nizar.
You know, it's very nice. Now, in this development, you need to align the home health care to increase the awareness and to maximize the relationship with home care and prevention, right? This is what they are looking at. Now, you need, as home health care, like the future care that I work in, okay? Now you need to increase the subspecialties. Now you need to develop your home health care physician. You need physicians who will take care of chronic people on ventilator. You want them to be ventilated at home with dignity. Their family is around. You want to take care of their PEG tube. You want to take care of a very sick people at home. So you need the subspecialties to be approved from insurance. It's on the benefit, for the patient benefit, because he will have less hospital-acquired infection. He will be at home. You need to develop the industry of home health care to do dialysis at home, X-ray at home, lab at home, everything at home, and you keep this person with his loved one, decreasing his infection rate, decreasing the number of complications. If you have this support, this vision, and you do in the prevention part, this is when you have a good industry to improve like the median rate. Let's just remind ourselves, we had in 2000 and around 9, the median life expectancy in Saudi Arabia was around 73. Now it's 77, and the aim is 80, right? We can't do 80 before prevention is in there and taking care afterward.
Excellent. So we're having an aging population in Saudi Arabia. You mentioned life expectancy has increased. We have close to 4 million people in Saudi Arabia that are in the advanced age. And this requires us to think of more creative ways of reaching out to this segment of the population. Coming back to Mr. Saeed, the Ta'awuniya has started new initiatives around primary care. I'm going to go back to your point about the pyramid. The most important thing before the sick gets sicker is to diagnose and prevent before the curative part of what you mentioned, people getting sicker. What initiatives has Taawuniya taken as new trends in healthcare to enforce the preventative side of medicine before the curative side of medicine?
Excellent. So as we said, we want to go from reactive to proactive, from waiting for the patient to get sick to prevention. How we do this is through, if we talk about, again, the people who are at the base of the pyramid, the answer is primary care. And unfortunately, we're talking at the backstage today. When someone gets sick, the first question he asks, he has a minor flu or a minor fever. Who is the top consultant in the city? And it is unfortunate. You are utilizing, a treasure. To me, the doctors, they spend so many years, gathering their qualifications and expertise. They want to see the people who are utilize their knowledge. You don't want them to see the patients that can be treated at primary care with GPs or family physicians. If we talk numbers, about 98% of the total volume in healthcare is in outpatient. 70 to 80% of that portion is primary care. Does not require going to subspecialty, top-notch physician, consultant to be seen by him to be treated. So what is the bottleneck today is the availability of primary care facilities, the availability or enough supply of family physicians. Until that happens, it will not be able to solve the problem. What Taawuniya is trying to do now, we have launched MENA, which is a subsidiary of Taawuniya, to have a network of primary care clinics and facilities across the kingdom, available in many locations and cities in the city, to be 10, 15 minutes away from you, to make the accessibility easy, to not wait for, waiting for 1 or 2 weeks to see a physician. You can just go, walk in, and you get treated. If you need to see a subspecialty physician, there is a referral system from these primary care facilities, from the family physicians toward the top-notch subspecialty consultants in case it's needed.
Wonderful. Dr. Nizar, we spoke of new trends in preventative medicine, new trends in reducing costs of healthcare, like home healthcare, etc. How can the healthcare industry collaborate with the insurance companies to ensure that we serve our beneficiaries in the best way possible?
I will give a live example between Taawuniya and Future Care. The Future Care is the largest home health care in the kingdom. We identified by Taawuniya there are very sick people with recurrent admission. They go into the hospital a couple of times. So according to their database, they came, we had a meeting, and then we said, you know what, let's have a very condensed supervision. We will have frequent lab. We will not wait for him until he gets sick. He will be seen by a physician once a week or twice a week. We will have a certified internal medicine and infectious disease and family medicine to supervise the whole program. So if they need anything. So now we are going to have data to show the kingdom that if a very good collaboration of identifying patients, you can prevent them going back. This means two things. Understanding of the insurance company about I am now developing in the company. We have a very strong IT system, unbelievable IT system, showing our physicians, our home care provider that they are receiving over there. We have a very highly qualified physician, nurses, pick line, caregivers. All of these functions have to be identified as insurance company will look into those and they will say, okay, this home care with subspecialties, they should be paid differently from a home care who will take care of cold. We will need both. We will need a home care who will take care of very simple antibiotics for 5 days, and you will need a home care company who will take care of subspecialties and very sick people. And they cannot be paid the same because I will lose then the market. Identifying this relationship will transform the care into the kingdom, making sure that we decrease complications. This is a good relationship. If I get encouraged by the insurance company because they are the payer, the more I get identified, the more I get support, the more I will move to a better care, decrease complication, and decrease cost.
Excellent. Going back to the industry growth, there are international healthcare companies looking at the market in Saudi Arabia. Example, Cigna came into the market recently. How do you see the future of the market in terms of growth, Mr. Said? Are we expecting more international companies to come into the landscape of insurance in the kingdom? Or are we self-sufficient and there's no need for additional companies to come in and provide more services?
No, as you said, I mean, the insurance industry is in a baby stage, infantry stage. It will continue to grow. We don't think the rate will stop. There are huge opportunities for growth and investment in the Saudi market. As we said, in the primary care area, the numbers say that the shortage today is in the range of around 3,000 primary care facilities. That's the shortage. So imagine the opportunities of investment in that area. And until then, it will be very difficult to have an enforcement for people to be forced to go to primary care before they get referred into the subspecialties in the hospitals. So that's why the strategy that we are building is what we want to contribute to bridging this gap, and we want to start with pull rather than waiting for the push. The regulator has given us the enablement for insurance companies to invest in the primary care, which I think is a very, very positive move. It is a game changer. It is an opportunity for investors, whether locally or internationally, to come into this market to contribute to bridging this huge gap, and it will have good returns. Once that's in place, there is the accessibility, there is the quality of care, there is the proof that medical outcomes are improving from this model, then the push might be ready for it as a market.
You know, one very important issue. Now, insurance and the healthcare will need to start looking into how I can look now from it's approved by all insurance companies from CCHI. Prevention, you can do a mammogram if you are in a certain age. You can do a colonoscopy if you are in a certain age. Now, if you want to go one step ahead, then you will not need your database to start sending an SMS. You need someone to call and say, you know what? You are a smoker, you did not do a CT scan of your chest. Why you didn't? We don't want you to get cancer. You didn't do your screening for colonoscopy for colon cancer. I will talk to the woman and tell her you have a booking next week to do the mammogram. I don't wait for them to go. I will even try to push the patient to take care of themselves before they get complication. I will need to assess the patient before he leaves. If he's walking well, if he's not walking well, I will have an automatic referral to a home care with physiotherapy for 2 weeks until he walks well, because I do not want him to become disabled. Having this vision, proactive, as he said. Now he said, this is what they are doing in the automobile. Now I will give you points if you take care of your health. As much as we do this, until the community teach and learn to take care of themselves and to be proactive, we will need to do our job, is just for us to initiate. You know, some of the deals, we deal with it, and we go to insurance company as home health care. I'm not talking about Taani, but you will have people who will totally try to downgrade the payment that you get, the deals that you get, because they do not still until now feel how important is you as partner. You need to get a certain amount of payment so you can continue growing in your subspecialties and services. And this is what we need, is the understanding of the health care for prevention and home care afterward. By this, as much as the regulator and insurance will understand this, we can improve the health overall.
Wonderful. Again, the need is huge for primary care. The need is huge for additional insurance services into the country. How does Ta'awuniyah differentiate itself in the market, other than the primary care network that they're establishing, other than the focus on prevention? Are there creative innovative new ideas that Tawniya is introducing to the market in any insurance sector, not necessarily in healthcare specifically?
Right. Excellent question, Samer. As I said, what we're looking at is the end-to-end experience, whether it's in the mobility sector or in the healthcare sector. The innovation and creativity is to follow the trends of what is happening, especially when we come into the digital world. We talked about MENA, the subsidiary in primary care. We also have TRI, a subsidiary in the digital world, where you have an end-to-end insurance experience, purely digital. And it talks to the new generation to make it a seamless, comfortable experience from end to end. When we talk about mobility, it is all enabled by digital capabilities. As we said, selling and buying a car, it's now done digitally. You will have the buyer or the seller picking up or dropping off the car at your in front of your house. As we said, if they get into an accident, the whole experience is digital without doing anything. Selection of a workshop, getting the feedback that the car is fixed, dropping it off back to your house. And also we're looking at other value-added services without getting into an accident. That the checking the car, the annual checkup. Similar in healthcare, it is all enabled by digital. You can now go to the Tawniya app, you do a virtual consultation. If you need a lab, the lab will come to your house or to your workplace, and they will get the sample. If you need the medication, the prescription will come to you electronically, and the medication will be delivered to you at home. So again, the concepts are not very difficult, Samer, and the audience. The execution, the differentiation will become in the execution. And I would like to mention that in the last 15 years or so, since the inception of regulatory insurance, the last 15 years were building the foundation and the basics. Now we have reached a level where we can get into excellence. We can get into world class. And the healthcare and insurance has been an attractive industry for top talent who will make this happen. And I'm very optimistic. And the government has given all the enablement to make this happen. No prevention. Its environment is perfect from all stakeholders in the government to make the world class in our country possible, inshallah.
Wonderful. Dr. Nizar, you are a social media influencer. You are a radio show anchor that I enjoy watching and benefiting from the information you spread in the community as part of your personal social responsibility, as if I may call it. We have 2 minutes left. I want you to advise the audience on how they can improve their health and deploy wellness in their life.
Well, I will just say this was a surprise question. But anyway,
it is. It's not in the script.
But I have to say, just before one thing, if you are asking, I want to say that we, in Future Care, I have one future plan. We are developing the subspecialties, but we need to develop a program for the home care, family, how to take care of their loved one, to prepare them psychologically and hands-on, how they take care of a person who is bedbound. This is the future. Spiritually, how can you prepare them for all the difficult decisions? But from my side, I always tell everyone, please, do not wait like me until you get very sick and then you lose weight.
And you had an experience during COVID.
Try to take an initiative. Look at your family. As Mr. Say said, look at your family. If they are having diabetes and hypertension, I promise you, just get overweight, you will get diabetes. I promise. So if you do not want it, then work on it. But if I spend years of my life, although I am a physician, but I spent years of my life knowing the difficulty in diabetes, but I still loved food. I took insulin and ate more, gained more weight until I gained consciousness. And now I
lost a huge...
Lost 66 kilos, yeah.
66
this is
kilos.
half of me went
So
out.
it's possible.
Everything is possible.
Yeah.
So I just tell everyone, please take care of yourself learn. The more you learn, the more you act. It just takes commitment, but it's for your better future. Don't wait for medication to happen. Try to prevent medication happening into you.
Blood pressure is a silent killer.
Wallah,
Many of us walk with it. We don't know it.
Wallahi, until last week, nobody understands. It's always the sentence I hear in my clinic. I never thought that I will have this. This is the problem. I will never thought that I will have lung cancer. I never thought that I will have this kind of disease. Don't wait until you say this sentence. Please act fast.
Thank you. Wonderful. Last word, Mr. Saeed.
Well, I would like to thank you, Samer.
Thank you very much.
I hope the audience enjoyed the session as well and they gained from it. Thank you very much also for Dr. Nazar.
Thank you, everybody. Thank you to the Saudi capital market for this session. Have a good evening.
Thank you.
Thank you.
Thank you, gentlemen. Last but not least, I would like to introduce and moderate the last panel for the day and for this year's annual SCMF. And it's a panel that focuses on the role of sustainability with some of the industry's most renowned figures and pioneers. Please help me welcome to the stage Aramco's Vice President, Energy and Economic Insight, Mr. Mus'ab Al-Mullah, Saudi Electricity Company's Senior Vice President, Finance and Group Chief Financial Officer, Mr. Abdulaziz Al-Muhayza, Aqua Power's Chief Financial Officer, Mr. Abdul Hamid Al-Muhaydib, and the Regional Voluntary Carbon Markets CEO, Ms. Riham El-Ghizi. Thank you. Once again, my name is Widat Talib. Just again for clarification, formerly a CNN business reporter, currently in my transitionary period. Welcome, my panelists, my speakers. I'm going to start with you, Mr. Mus'ab. His Royal Highness Prince Abdulaziz bin Salman, the Minister of Energy in Saudi Arabia, said at a conference in Dhahran that Aramco is halting its output expansion because of its energy transition. And he said specifically, and I quote, "Our oil company now is becoming an energy company." And considering the more pressing concerns faced by developing economies, and precisely when we see that OPEC is still expecting a strong demand growth in oil markets, in your mind, how should industry leaders address the widening responsibility gap regarding climate change and sustainability, and what are the steps that Aramco is taking to ensure, the green energy transition?
Thank you, Widad, and I'm glad to be in this forum. So to answer your questions, let me start by energy transition's narrative globally today. And I would always refer, and actually today we were in Kapsark and Riham was with me in the panel, she was referring to the same reference, the World Economic Forum Energy Transition Index. If you look to the World Economic Forum Energy Transition Index, the latest one, when they talk about energy transition, is not only sustainability. It's a 3 dimensions. It is sustainability, energy security, as well as what we call it equitable energy transitions. So, and by the way, for those who did not read this report, it's good maybe to read it, because you can see with this new index that's being built by the World Economic Forum, Saudi Arabia progressed very much in the ranking on that index, and it's leading the whole regions because it meets the whole objectives of the energy transitions. Because people think energy transition is only climate. No, you have to solve for energy security, and you have to solve for equitable energy transitions, which is referring basically to be affordable, providing affordable energy. Now, your questions, how we can basically close that gap. Why I start with this? Because closing the gap is not only climate. Closing the gap, you have to solve for the 3 parameters here. I will give you the example of Saudi Aramco. Saudi Aramco, as probably most of you know, they are the most reliable energy supplier to the world. We don't miss a barrel, even in the most let's say, difficult situation globally. And there is a lot of proof records, Abgate crisis, the COVID, all these situations, it shows the resilience of our energy system to provide secured energy system and reliable to the level of 100%. Now, people think that's only what we are solving for. No. If you look to the 70s, in the 70s, Saudi Aramco, capturing basically the economic boom of Saudi Arabia, they worked on what they call it reducing the flaring. So basically, capturing or using the associated gas. Instead of flaring it, building a master gas system that basically provide gas to the whole country, including power generation plants as well as industries. This reduced the emissions big time because flaring is the main problem when it comes to the oil and gas industries. So looking at this, you can imagine, since the 70s, Aramco worked on that, no wonder for people to see the numbers of Aramco, they are the lowest in carbon intensity today, or one of the lowest today. If you put things in context and numbers, we are talking about 10.3 kilograms CO2 per barrel. The whole industry is 38. If you look to the whole industry, it's 38. You can imagine the difference between Aramco and the remaining oil and gas industries. Just to put things in context for the audience here, if the whole industries, the 38 basically average, go to the level of Aramco, you are saving around more than 1 gigaton of emissions annually. That tells you how important, which is a huge and significant for climate change. My point is, we are not solving only, since the 70s, not solving only for the reliable energy source, but also for sustainable energy source. To add, we did not stop at this point. While our carbon intensity is one of the lowest, we have put a target, we put net zero by 2050. We are also putting a target, interim targets, to reduce our carbon intensity further by 15% by 2035. And we create what we call a decarbonization journey with 5 levers. And I will just quickly talk about these 5 levers because I think very important to talk about it. The first one is energy efficiency. It's very important for people to understand that energy efficiency is the most prominent solutions for climate. Renewable alone will not solve the problem. If you look to the whole renewable, with the scale up, today it's only contribute 4% of the total energy demand. But efficiency improvement is very critical. It saves a lot of emissions, basically, to reduce a lot of emissions. So energy efficiency program, where we manage to reduce our emissions, but also we build what we call it cogeneration plants, which produce power and steam at the same time, which boost the efficiency. Instead of producing power, taking it from the grid and produce steam from boilers, we build...
You combined.
We combine, and this is around above 5 gigawatt of generations today coming in Aramco, which is the largest in the world, probably for industry, coming on Aramco facilities today. It's above 5 gigawatt. So energy efficiency is a key pillar for us to continue the progress there. The second one is flaring and methane. And maybe all of you know that methane is important. It's not only CO2. Methane is a problem today. So we achieved also the lowest methane, 0.05, compared to the whole industry, which is in the range of 0.2. So we want to continue to be near zero, what we call it near zero targets of methane and flaring, and this is critical levers for our decarbonization journey. The third one is renewable, and we are part of the journey of the kingdom. The kingdom announced 50% of the power generation will be in renewable, and we are part of that journey. We partner with PIF, Public Investment Fund, as well as Aqua Power, and contribute 30% of the investments in the renewable side, which contribute to around our share is around 12 gigawatt of renewable. The fourth one, which is very important, is the CCUS, carbon capture. The reason I'm talking about carbon capture, because the world today is very low when it comes to the global investments in CCUS. Yet, if you look to the IPCC, if you look to all reports, the globe has to scale up probably 200-fold the CCUS to be able to meet climate change and reduce the temperature below 2 degrees. So we are building today is the largest, or one of the largest, and I think if I recall it's the largest will be globally, hub in Jubail, 9 million ton CO2 capture per year. And the 9 is not all from Aramco. The beauty of CCUS, when you create hub to reduce the cost, you also capitalize on the industries around it. So we are capturing 6 million from Aramco and the remaining 3 from the adjacent industries in Jubail. So the project is ongoing now, and it will be completed by 2027 with partners, Schlumberger and Linde, and this will be on the ground in 2027. The last one is the offsets, and I will not talk a lot because we have the expert here, Riham, when it comes to the carbon offsets and carbon market, but we thought about the offsets as a key lever because although you are reducing your emission to the lowest, you will still have emissions remaining. Emissions will not disappear at the end of the day. Offset is a great solution and financing tool for projects globally that cannot get financing. So we want to be part of the solutions. We participate in the carbon market, and we are also planting mangroves. We put a target of 650 million mangroves in Kingdom and out of Kingdom to make sure we are offsetting our operations to meet the target of net zero by 2050.
That's fascinating. Thank you, Mr. Musab. I'm going to move on to Mr. Abdulaziz. The electric sector is also has immense importance when it comes to the energy transition. So in alignment with the Kingdom's Vision 2030 and its sustainability goals, how is the power sector addressing the increasing demand for electricity while transitioning to sustainable energy?
Well, first of all, thank you, Widad, and for having me today. I think we here in SEC, we cannot talk about SEC's energy transition strategy and fulfilling the demand without talking about the ecosystem strategy. The Kingdom has set a clear integrated energy strategy for the Kingdom, and that has been supported by a world-class policy, governance, and regulation. And since the reform in 2020 that basically transformed the entire power sector to work on a commercial basis, basically SEC become commercially enabled to do all of the above, to fulfill the demand that is coming from demographic growth, projects that are being built on the mega side under the Vision 2030, and also industrial, commercial, and other growth that is coming from a normal demand. The second thing is also when we look at the transition side, obviously the Kingdom has a target as it's set by the Minister of Energy, His Royal Highness Prince Abdulaziz bin Salman, when they set basically the energy mix for the Kingdom. Today we have the energy mix for the power sector is oil and gas based, and the energy transition, the target for 2030 is basically to have it renewables and gas with carbon capture technologies and batteries. Now, in order for us to do all of that, this generation definitely is given to the private sector, and where SEC will come and also participate there. However, our major investment will come in the transmission and also distribution. And when we talk about the transmission, we have a huge amount of investment from now until 2030, and this is going to be to basically to connect all the renewable projects that are being built here in the Kingdom and making sure that the system is reliable to capture and there is no bottlenecks in the system, and give options for the most efficient plan to dispatch in the system. Also connect the new projects, the mega projects, and making sure that we have a reliable service and promote basically the energy transition with the new projects that are being built. On the other hand, on the distribution side, we started already, since 2019 on the investment of the digitization and smartification of the network, and we've seen the project of the smart meter that has contributed significantly on the technical losses that obviously reduces the emissions on the generation side, as well as the commercial losses. All of this is going in line with the overall goal and strategy for SEC specifically to meet the net zero target by 2050.
Thank you, Mr. Abdulaziz. Mr. Abdulhamid, it's great to have you back once again on another panel. I'm going to dive into the ESG aspect of this discussion. ESG factors are increasingly being integrated into investment decision-making processes. So how has Aqua Power's decarbonization efforts helped attract sustainable finance, both regionally and internationally?
Yes, thank you, and good afternoon, everyone. Assalamu alaikum. So, I was in a private event a few weeks ago on wealth management, and there was more than 120 different people, I would say not across GCC only, but also across the Middle East. And there was a question raised, and everyone was supposed to give in a poll his answer, yes or no. And the question was about, is ESG part of your consideration when you do an investment. And this is a private wealth kind of forum, so you would expect the highest kind of maturity when it comes to decision making, and only 5% said yes out of 120 people. So the message here is that while companies and corporates are working significantly on their ESG kind of agenda, ultimately not all the asset class are ready to pay a premium for such an investment. I think a lot of them are still not backing behind. So that is something that we should always keep in mind. I think banks in general have been able to move debt capital market and debt financing and project financing into a better position supporting ESG kind of targets, but not on the equity side. So talking specifically about AquaPower, when we look at ESG, really it's actually part of our business model. It's not we don't have an ESG agenda or strategy that is different from the business model. Our business model already integrates ESG as part of it. And maybe also going to another 4 kind of pillars that we can focus on. One is basically renewables. So big part of our portfolio is actually renewables. Today, if you look at out of the 10 bids that we are bidding in, 9 in renewable and 1 is conventional. Alhamdulillah, in the last couple of years, we were able to build our portfolio significantly into renewables. Today, we have more than 23 gigawatt of renewables in our portfolio. Just to put it into perspective for the audience, this is almost like the installed capacity of Oman, Bahrain, Qatar combined. And as we're going forward, we're going to even significantly build that to reach up to 100 gigawatt, being one of the top 3 players worldwide, inshallah. The second pillar is related to the water desalination. So AquaPower today is the world's largest privately owned company when it comes to the water desal with 7.6 million meter cube per day. We have been able to integrate renewables into the water desalination. So we have already 2 existing plants where they are run 100% on green power. One is the Red Sea project, and the second one in Hasiyan IWP in Dubai, where 100% of the power coming from green sources. We have also integrated other projects with different capacity with the objective of ultimately making the water much cleaner in terms of process. Then the third pillar will be more on the storage capacity. So today we are leading not only the region but also worldwide when it comes to the storage capacity. We have built the largest thermal energy storage in the world. Today, if you ask anywhere in the world, actually the biggest thermal energy storage being built is by AquaPower. We have 3 different projects between South Africa, Morocco, and Dubai, where the whole capacity is significant. We have actually one interesting project we have is in Dubai, where the thermal energy capacity is more than 500,000 ton, equivalent to almost 1 gigawatt of PV that you are building. The fourth pillar when it comes to the energy transition that we are leading is actually converting conventional power plants into a more efficient, or let's say more sustainable plants. And this is something that we have done in 2 instances where actually a plant used to be run in coal. We have been able to convert it into gas, clean gas. So that's something that we have done in the last 2 years. Another plant is that we are taking it to decommission, that is run in heavy crude oil, and replacing it with a new plant that's run in sustainable energy. So this, in summary, basically where we are trying to lead our energy transition targets.
Thank you, Mr. Abdelhamid. Ms. Riham, he was touching on a point that I believe is very important, which is carbon offsets. So I would like you to please give us a short background on VCM and what precisely voluntary carbon markets are, and even the role of VCM in the decarbonization process.
Okay, first of all, thank you, Dad. Really appreciate the opportunity to talk here today, but I cannot start my conversation without giving a nod to Saudi Tadawul Group for the great organization, the seamless movement, the ushering people, the cameraman, people at the backstage. I came here a couple of days before the conference and I saw how much effort it does take. So congratulations to Saudi Tadawul Group for a very successful conference, and looking forward to seeing the award ceremony afterwards. Going back to your questions about the voluntary carbon market company, the company was established. I'll go backwards even more. The company started as an initiative announced by His Royal Highness the Crown Prince of Saudi Arabia back in September of 2021. It has tasked PIF, the Public Investment Fund of Saudi Arabia, and Saudi Tadawul Group to look into this initiative and make it executable. So setting up a voluntary carbon market, one of its kind, the first in our region. And this is part of Vision 2030. This is part of how Saudi Arabia is progressive and ahead of the curve in our region. The company was established last year in October. Not last year, 2 years ago. Now we are in 2024.
Time flies, yeah?
Yeah, I know. In October 2022, 80% PIF and 20% Saudi Tadawul. It was inaugurated with an auction. It was the biggest auction in the history of the voluntary carbon market altogether, with 1.4 million ton and 15 Saudi companies participating to it. When we first started the project in PIF, there was zero supply and zero demand in our region. In fact, when we talk to different companies here in Saudi Arabia, and we would say, we want to talk to you about a voluntary carbon market, they would say, Ms. Riham, you're speaking Chinese to us. What does that mean? And from that to a region that is contributing to 3% of the global supply and demand because of the auctions that the voluntary carbon market has achieved in the past 2 years. We did another auction back of last year in June in Nairobi. We took with us Aqua Power, Saudi Electricity Company, Saudi Aramco. The three companies came with us together with other 16 Saudi companies, and we had yet another setting the record for one of the biggest auctions. Why did we go to Kenya? Because we wanted to walk the talk. We wanted to go where we can make an impact. We, as a company, see ourselves as one of the biggest markets by 2030, a global market that is making an impact and livelihood, not only in Saudi Arabia, but beyond, in the global south. This is our ambition. Integrity is part of what we are about. Integrity is at our core. So this is a snapshot about the VCM. One last thing before I close this. Musab has mentioned the World Economic Forum and Saudi Arabia progressing 24 slots because of the scale of deploying the renewable energy a strategy here in Saudi Arabia and the auction that we have done. So getting a recognition in our first year from the World Economic Forum, being part of progressing Saudi Arabia 24 slots ahead of other 24 countries is a source of pride for all of us in PIF and Saudi Tadawul and in the company. So this is our history for the past year and a half to 2 years. This year we're going to launch in 4Q our exchange. Is going to be the first exchange that's going to deploy Islamic finance. This is one thing, again, to speak about Saudi Arabia and how Saudi Arabia is progressive. We worked with different banks here in Saudi Arabia to issue the first ever fatwa to allow for carbon credit also to be a backing commodity for Islamic financing.
Fascinating.
Nobody else has done that. Nobody else. We have done that here in Saudi Arabia. So this shows you the appetite for doing something different over here. Not only we embraced the first regional voluntary carbon market, but we're going beyond that and setting a standard for a global finance and innovative solutions for carbon markets. Now that I spoke about the carbon market and the history of the VCM, I would like to mention what is a voluntary carbon market. It's a market like any other market. There is a supply and a demand, buyer and a seller, project developer and a buyer like Saudi Aramco, for instance, like what Musab has mentioned. The buyer will be companies that have climate ambitions to reduce the carbon footprint and utilizing carbon credit offset as a mechanism to reduce their emissions next to their decarbonization plans. So this is a buyer. Who is the seller in this market? Is a project developer like Aqua Power, the projects we bought from them in Egypt. So what is the projects that are out there? Is project that reduces or removes CO2 from the atmosphere. It is that simple. Removes, how do we remove CO2 from the atmosphere? Give a simple example. Plant a tree through photosynthesis, you remove your sequester, so forestation. Reduce CO2 from the atmosphere, put a filter on a cement plant, reduce and measure how much you reduced. Why would a company, why would a cement plant go and put extra capital on filters? And I'm giving very simplistic examples to the audience to understand, because carbon credit offset is a revenue stream that could help them finance these activities. So what is a carbon credit offset? Is 1 ton of CO2 that has either been removed or reduced from the atmosphere. It gets measured through different standards. Currently, we have more than 300 standards for 300 different activity. And once that gets issued through a verifier, somebody who comes and audit and make sure that this happened on the ground, certificate is issued to the project developer, who can sell it then on the voluntary carbon market, be it over the counter or through an exchange. So this is in a nutshell. Did I answer all of your questions?
Thank you. Yes, you did.
Thank
very,
you.
very extensively. Thank you. Mr. Musab, back to you. Briefly, please, because we're running out of time.
Okay.
The world is headed towards great change when it comes to the energy transition. And as someone who has covered, energy markets for a while, I've reported on and I've personally witnessed, the humongous amount of investments that is required for this transition. And some estimates show essentially an additional $25 trillion that are needed to realize the energy transition. So insurance could be a challenge here. How do we ensure that sustainable energy investments in the global south is prioritized?
Thank you, Dad, and I will try to be short, but to put the context of global south. If you look to the advanced economy today and you talk about GDP per capita, you are talking about 55,000 versus 7,000 in the global south. So just to put the context, the global south will need to increase their GDP per capita, which means needs energy. That's definitely the case. When you look to the 2050, how the energy mix globally will be, 72% of the energy needed will be in the global south, not in the global north. So my point is, the narrative will be driven by global south in the future, because they are the one who will need energy, and they will probably, the countries also will be suffered from climate change. Hence, the narrative will be driven by global south. Not only that, 90% of the hydrocarbon resources today
are from the
global south. So you cannot imagine these geographies, they have resources and they cannot monetize it. They have to monetize these resources. Economic 101 require basically these countries to monetize these resources. So my point is, back to the energy index, you solve for 3 things. How to provide energy security, because energy security is critical to all countries. How to provide it in an affordable manner, because these countries, they need economic prosperity, okay, especially in the global south, while they need to decarbonize. And I give the example of Aramco from industry side, how we are doing this formula. Now, talking about numbers, the issues of the numbers talk about 25 trillion and so on. If you look to these numbers, the problem is probably they are not technology agnostic. They are talking about energy transition cost of 25 trillion if we change everything to renewable. But however, if we talk about the global south and you talk about monetization of these resources, you put CCUS, you be technology agnostic without targeting specific technologies, as long as you are reducing the emissions, I would say that cost will be lower. The problem, all the numbers you see today, especially from, I would say, the West, these numbers coming from the West side, is focusing on certain solutions and one pathway of energy transitions. However, if we look at it differently, factoring in what you mentioned about global south requirements, which is economic prosperity while they manage the carbon emissions, which is doable, probably the cost will go down. And this is something for the audience to think about, is this 25 trillion could be probably 15 trillion. I'm not quoting any number here, but I'm saying these numbers, let's not take it, let's put it in a context without taking this number as a granted. I hope I answered the question.
You did. Thank you. Mr. Abdelaziz, on that same point, what financial models is SEC using, or partnerships or funding instruments? Are you exploring to fund these kinds of initiatives, and what do your future investments look like in that regard when it comes to sustainable energy?
Well, I think we realize that we are operating in a capital-intensive business that requires a huge amount of funding to finance the transition, the change, the growth. And since the company's inception, I think the company have been relying commercially in financing all of our activities from the loan market and debt capital market and ECAs and others. Now, when we look at the future, obviously it's a huge amount of investment is required. When we talk about only just transmission and distribution, the expectation is that we will be investing more than $100 billion in the next 5 to 7 years. And the strategy for the company was that we will continue to finance our transmission and distribution businesses using our balance sheet, tapping into the most competitive, efficient capital market to finance these projects, and we will continue to do this in the future. However, on the generation side, this is going to be more in a partnership, and SEC started the IPP model, which is the independent power producers, back in 2005. That's almost 19 years ago, and now that model is being obviously implemented entirely for the kingdom. SEC's strategy for the growth that specifically is going to be through a partnership with different players in the market, and it's going to be financed through project finance and off-balance sheet. Now, even for the balance sheet financing, we're trying to be as efficient as possible and leverage the amount of investment that we do in the energy transition. And that's why we've been active since 2020 on the green space and the sustainability financing space. We issued the first DCM issuance out of the kingdom on the green space. We signed more than 6 deals on the DCM, also on the loan market, and ECAs on the green and sustainability-linked financing. So we will continue to tap into this to make sure that we're financing all of these energy transition projects in the most efficient way, as well as maintaining the cost of capital at the lowest possible way.
Right. Thank you, Mr. Abdulaziz. Back to you, Mr. Abdulhamid. Back to the point we were discussing about, the Global South. In ACWA Power's efforts to unlock the vast potential of renewable energy in the Global South, what can we expect in terms of driving the economic growth and environmental progress in these countries?
So I would like to take it actually from His Excellency Khalid Al-Falih. Yesterday he mentioned green shoring, right? And I think this is an excellent term that maybe I would like to expand on. Definitely the Global South do contribute 90% or more in terms of the energy contribution, but also if you look at it from the renewable part, I remember 7 years ago when the vision came and there was an expectation that renewable will be not only serving the local market, but also being exported. Everyone was asking, how can we export renewables? So it was difficult maybe to think about it in a concept that we will be connecting grids everywhere, even though that SEC actually doing a great job connecting both Egypt, GCC, and potentially more in the future. But ultimately, as you are building more and more capacity, it will be difficult to do it. So this is something that we contemplated together with several partners, including Air Product and NEOM, and starting building a real massive project on the green hydrogen, where ultimately you will be utilizing the great land space that we have in Saudi, the great solar radiation, GHI, in Saudi, and also the great wind speed that we have in Saudi. You ultimately end up producing equivalent more than 4 gigawatts of renewables, convert it into a green ammonia ultimately, and ship it to the global north. Most of the customers actually in the global north. So that is a great example of building the connection between both the south and the north in a way that utilizing the best and the most competitive, let's say, tariffs to ultimately help decarbonizing the whole economy. So this was the first project. We have now replicated with another project in Uzbekistan, where ultimately we are going to capitalize on the great wind speed, great land space in Uzbekistan to ultimately produce green ammonia that also can be exported to the global north. And that's only the beginning of a journey that we are planning to do in the next 6 to 7 years, where we're ultimately going to build up on that specific capacity. So with that in mind, I think it's going to be very challenging for green hydrogen, for example, producer in the global north to capitalize on a similar competitive edge that we are having here in the global north.
Right, thank you. Ms. Riham, I want you to please tell us how is VCM in Saudi, specifically right now, contributing to climate action and mitigation in the region and perhaps even globally?
Well, I kind of alluded into that when I mentioned that we were at zero when we started the journey. No awareness, no knowledge about the market at all, to being recognized globally. Like I was at one of the panels in COP and someone said, we want to follow suit with what Saudi is doing. So that global recognition, starting from nothing at all, that is a great thing. But this is only the start and the beginning of the journey. I think one of the things that we need to focus on when we set up the voluntary carbon market here, we looked at it, and as I said, the initiative was set by His Royal Highness the Crown Prince, and it was to set up an exchange. When we looked at setting up an exchange on its own, we thought it's not going to work. You know why? Because there is zero demand and zero supply, and then we thought, okay, fine, if this is not going to work, what do we do? It's about the ecosystem. How do we have an ecosystem over here in Saudi Arabia? So the company is set up on 3 pillars. The first pillar is exchange, and exchange is very important in the voluntary carbon market space because 80% of the trades are done over the counter. Give you an example, what does it mean over the counter? Was that when I was intermediating for auction number 2 in Nairobi, I was offered a carbon credit offset at $25 a ton, and I was intermediating. Right after the auction was done, I didn't take it. I was re-offered the same credit at $15 a ton. How do you know the right price? Exchange help in solving that because exchange is a platform, everything is transparent and helps in price discovery. So this is what the exchange is going to help. The more liquidity we have on the exchange, the better prices we get, and the visibility of what is the optimum price for carbon credits. It helps mobilize finance into supply. Now, this is the first pillar. The second pillar was supply. So we looked into that. There is zero supply in our region. It's almost zero, except for some projects in Egypt and some in Morocco. But that's it in our MENA region. So we thought we need an investment fund to start deploying some of the funding projects here in Saudi Arabia and beyond in the global south as well. So that's the second pillar, to solve for the supply. The third one, which is the advisory services. So we're setting up advisory services to help, increase the awareness. That's why we have 16 companies on the demand side in the 2 auctions, from 0 to 16 big companies in different facets of the Saudi economy. We have hosted last year here during the FII, in collaboration with S&P, a conference where we gathered the global leaders to talk about voluntary carbon markets. What do we expect? And it was the Riyadh edition to talk about the future in the global south. There is a disconnect, like what Abdul Hamid alluded to. There's a disconnect between the global north and the global south. The global south, yes, we produce a lot of energy, but for instance, to give you an example, 3% of the global emissions come from Africa. Yet, 96% of the debtors comes from the most poorest countries in the world, from climate. So this is, you don't emit as much, but you're more vulnerable.
Not fair.
Yes, so when you talk in any room, there is a disconnect between conversations and dialogues between the global south and global north. What does the global south want from voluntary carbon market? How do we push and move regulations? How do we increase transparency? How do we make sure that there is a just and equitable transition as we decarbonize the global economy and make sure that the voluntary carbon market that can play a big role?
Just to touch on that point of transparency, how are you dealing with those kinds of challenges? Because it is a huge challenge in the carbon market, the global carbon market, actually, and also what they call the real carbon emissions. How do you mitigate through these challenges? And also, how can companies and stakeholders get involved in this aspect?
Well, the optimum thing is companies shouldn't get involved in this. If I'm a company and I have a net zero strategy and I'm going to go and buy an offset, I don't need to worry about the integrity of that credit and the transparency of it. that should be self-corrected by the market. I'm a buyer. I shouldn't go and do my own due diligence. It's a lot of overhead on companies to account for it. What do we do about it in VCM? And this is another overhead on me, but I'll tell you where I see the light at the end of the tunnel, because this has been an issue. In VCM, for the 2 auctions that we have set up, I set 2 separate due diligence teams, not talking to each other, everyone looking at each and every credit, from an additionality, from permanence, from reputational of the project developer. One of the projects was a great hydro project, but did population displacement. So in terms of co-benefits, the population were forced to leave their homes. We excluded that. So there's a lot of things that we have done, and any red flag we excluded, because this is the name of Saudi Arabia on an auction, and we are very protective of the name of Saudi Arabia. That's a big name that we're putting out there. So, but that's also an overhead. That's a lot of work on us. So the 3 things that I see that are working for integrity, and I think the market is self-correcting, which is really good. I see that there has been a lot of articles criticizing that in the market, and we welcome that. I know a lot of people will be surprised, but that is a very welcome news, because it forces the market to self-correct. It's like any other market. We will have issues, we will correct, and we will move forward. I would say we have rating agencies that rate all of the carbon credits based on A, B, C, on grades, and we will offer that on our exchange for buyers to be able to see. The second thing, which was really good, the Integrity Council for Voluntary Carbon Markets, which is a non-for-profit organization that oversees the integrity, came together with SBTI, Science Based Targets Initiative, and VCMI, another initiative. 3 of them came in COP, and they set an end-to-end framework for integrity. And this is very important that we follow the core carbon principle initiated by that, and we will only offer these credits on our platforms. So again, buyers shouldn't be worried about that. That is not fair to the buyers. It's not their job to follow how is the credit and audit it. They should feel confident buying a credit. And this is what we're trying to provide with our platform, to provide the confidence to buyers that you go, and this credit has been vetted and went through a lot of due diligence.
Right, thank you, Ms. Riham. Mr. Abdelhamid, sustainable finance encourages innovation and technology processes and business models that promote resource efficiency, reduce emissions, and enhance social equity. And this is something that Mr. Marco, the CEO of Aqua, spoke to me about very extensively in my interview with him last year. So how has that specific kind of innovation contributed to Aqua Power's role, and would you say it placed you as a global leader in that aspect?
Thank you. So we, in the last 2 decades, and since Aqua Power born, I think the spirit of entrepreneurship has played a significant role in taking innovation into account. So yes, we have taken innovation very seriously, and we even bet on it in a lot of times. The technology itself plays a significant role in pricing and ultimately the tariff that you are offering to your clients. We have been able, through the life of Aqua Power, being offered a very competitive tariffs to our ultimate off-takers, utilizing our innovation, whether it is in the project financing, whether it is on actually the technology itself, whether it is actually on the structuring of these transactions and scaling it up into a certain level that allows us to offer even a more competitive kind of tariffs as we are scaling this project up. Just to give you an example on 3 different technologies, right? So in the photovoltaic, in the last decade, we've been able to reduce it by almost 80%, the tariffs. I remember the first project, I worked on it myself, it was around 5.8 cents per kilowatt hour. Today is 1.2. Of course, after inflation, it has gone to 1.7 cents per kilowatt hour. That's 80% discount on the tariffs for the solar photovoltaic. And the CSP technology, which is the concentrated solar power, is around 60% in less than a decade. When it comes to the water, it's around 60% in a decade and a half in terms of the price per meter cube per day. And this is all driven by significant scale of project that's been done by Aqua Power, taking the risk of certain technologies, certain structuring that ultimately delivered to the end users the tariff that they are wishing for.
Thank you. Mr. Abdelaziz, very briefly, please, how do you see the role of ESG and sustainable finance and regional sustainable development?
I think it is becoming more and more important. I think if we talk about like 10 years ago, I mean, you won't be seeing a lot of investors speaking about environmental, social, or governance practices for companies with companies. Now, with the ambitions that the kingdom has, not only just for the energy transition, but also from economic perspective, His Excellency Ibrahim mentioned yesterday that debt capital market and equity capital market, the target is to contribute this, to see this contributing to the GDP 18% by 2030. Now, when we go and see investors, we're not only discussing credit, we're discussing also ESG and ESG practices. I think what we've seen now I would say in the Saudi market is a great job, a great phenomenon that seeing a lot of companies are coming to that practice to a global level. Myself personally, I've seen EC's experience when it comes to speaking not only just to investors, but also ESG rating agencies, discussing them, the practices that we're doing. I think that's becoming more and more important. And I think this is just a path that is becoming more and more aggressive over time.
Certainly. Mr. Musab, I will be closing on my last question with you. Do sustainable finance criteria need to be more holistic and pragmatic, especially when designing financial assessment methodologies like ESG or green finance?
Absolutely. I mean, probably the issues of green financing is the limitations in technologies that they're investing in. And it's the focus on probably few solutions, including renewables and others. But when it comes to, for example, carbon capture and storage, some banks today, they don't consider it part of their green financing. Mm-hmm. And today, if you look to that energy transition cost in 2022, 1.1 trillion, only 0.6% invested in hydrogen and CCUS. The reason is green financing is not supporting it. Now, if you look at this, I know there is a few seconds, for companies, what does it mean? Probably it's irrelevant to Aramco because we do venture capital, we are investing in sustainable solutions, including CCS solution startup, and we increase our even venture capital from $3 billion to $7 billion with a focus on the sustainable solution. But the worry is globally, the green financing definition needs to be technology agnostic to reduce the emissions.
Certainly, certainly. Thank you, Mr. Musab, and thank you to all my panelists today. It was a lovely panel, and that's our time for today. Ladies and gentlemen, thank you for tuning in.
So that concludes the second and last day of this year's Saudi Capital Market Forum. Truly, it was a day full of insightful outlooks and definitely a better picture on what the Saudi capital market looks like and stands for. I would like to thank everyone for being here today, and without you, this wouldn't have been possible. Once again, my name is Widad Talib. Good night, ladies and gentlemen, and please, the invitees can make their way to the SCMF Awards ceremony. Thank you so much.